we should not be surprised that we are seeing volatility. You still do have a sort of K-shaped market.
In the near term, caution is warranted.
It's early to abandon any bullish call. We own what we own. If the market goes down and these stocks go down, we're going to buy more.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, the Supreme Court pushing back. America's top court appearing skeptical of the president's trade policy as dysfunction in Washington is leading to reduced airport capacity. U.S. companies announcing the most job cuts for any October in more than 2 decades.
This is the Challenger Craig Christmas data that came out earlier this morning that showed a huge surge in the announced potential layoffs that companies have planned. A real question here. Are these just idiosyncratic moments when you look at sort of the data warehousing and some of the technology-related sectors at these areas where these layoffs are concentrated? How many idiosyncratic stories make a theme? And I think that increasingly is the question.
I think we've got to highlight the counterpoints in the last 24 hours as well. ADP improved. ISM services, we talked a lot about that ahead of time yesterday. That number was much, much better than expected. And you take the data on a whole this week, you'd argue that things have stabilized, maybe even picked up just a little bit.
This is the conundrum. Things have stabilized. Economically, yes, you could argue that they're even reaccelerating. But what everyone keeps saying is it comes without job creation. Is it because of the immigration story? Even within the ISM services, planned hiring speaks to a potential even contraction in employment, even as prices paid goes up, even as you do see orders really pick up. So there's a question here. Can you get a jobless recovery? And how does the Fed deal with that? How do, frankly, investors deal with that when they're facing off with companies?
We need to talk about trade policy as well. Quite a hearing in the last 24 hours. Justice Barrett with this to say. So is it your contention that every country needed to be tariffed because of threats to the defense and industrial base? I mean, Spain, France, question mark?
Look, there was a lot of pushback, questions around what else this sets a precedent for future presidents to do if presidents do have the power that a lot of justices were arguing really relies on Congress. They talked about this being a tax. That is not what the administration wants them to be talking about. It points to what is the pathway to remediation if the Supreme Court does overturn this? How wholesale could they overturn this? And what is President Trump's response? Right now, the idea that conservative justices are pushing back just as hard as some of the more liberal wing of the court really raises questions for a lot of people in the market.
The market move at a stock level, I think, spoke for itself yesterday. 3 names for me: Lulu, Macy's, Mattel, rising 4% plus in yesterday's session. Kind of spoke to the mood of the moment down in Washington, D.C.
A sense that maybe some of these would be overturned, and the retail sectors that were most affected by some of the tariffs, in particular in Southeast Asia, could get some sort of benefit. But again, that's also a question. Is this going forward? Is this looking back? Do they get that money back? How do they deal with suppliers? How does this deal with domestic policy, international policy? I mean, there's so many questions. More questions than answers that come from this.
The refunds could be an absolute mess, a total mess. We'll get into that in a moment. If you're just joining us, welcome to the program. Equity futures looking for a bounce here, trying to add to some gains yesterday. Equity futures up by not even 0.1%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as stocks look to find a firmer footing. The former Trump White House trade official, Kate Kalukowicz, joins us with U.S. tariff policy hanging in the balance. And Maureen O'Connor of Wells Fargo as big tech takes on record debt to fund the AI arms race. We begin this hour with our top story. Layoffs in October surging to a more than 2-decade high. Bloomberg's Mike McKee joins us now for more. Good morning, Michael.
Good morning, John. Well, Challenger Gray and Christmas puts out their job cut announcements every month at 7:30 in the morning. But today came out about 4 a.m. Challenger releasing them early because why not start everybody's day out with some bad news? 153,074 job cuts in October. That's the highest for that month since 2003. And as you can see, the numbers there up significantly over the last year or so. And the 2025 total is 65% higher than it was a year ago. Challenger blaming AI, softening economy. They also blame Doge job cuts. There are some caveats, though, that we need to point out when you start talking about Challenger. First of all, they're compiled from company announcement plans. Companies don't always follow through, and they give workers, in many cases, a long runway. Apple, for example, cutting jobs, giving people several months, and the same with Amazon. They gave 90 days notice. Some cuts come through attrition rather than just firing people, and the cuts are worldwide, not just in the U.S. So it doesn't necessarily mean, as you were talking about at the top of the show, that we're going to see this many people lose their jobs, but it does suggest the labor market is softening significantly, and it raises those questions about what the Fed does in December.
We're not going to settle that debate anytime soon. Mike McKee's going to join us later on in the programme to break this down and talk about that Fed debate. This bond market, whipsawed day to day. This morning, yields are lower by a few basis points. Yesterday, they were higher. We had decent data. And dare I say, maybe the Supreme Court debate was more instrumental in the moves we saw in the bond market than anything else was.
The theory here is that if the United States cannot collect some of the tariff-related income or has to give it back, what does that do for the deficit picture and the fact that that offsets some of the savings that came from the additional spending in the bills that were passed earlier this year? A real question here about whether this is going to be a bond market issue and liability come the end of the year.
4:13 on 10 so far this morning. Here's the view on Wall Street. Seema Shah of Principal Asset Management writing, while there are threats to the risk on stance, particularly amidst lofty valuations, fundamentals continue to underpin markets. Seema joins us now for more. Seema, welcome to the programme. Meta last week, Palantir, AMD and now Qualcomm, all reporting fairly decent numbers for most of them, and this equity market has pushed back. What's the signal you take from that?
Hi, John. Thanks for having me on. Yeah, it's been really interesting this earnings season to see how the market is punching companies even as they're continuing to deliver. And I think that speaks to a lot of skepticism within the market, which has certainly started to really gain momentum, I think, within the last few weeks as well. Probably around the size, the size of numbers that we're seeing with regards to their AI capex, the hope that these companies are really going to continue to promise on some of the productivity gains that they have. So I think the jury is out. What we're trying to do is look through some of the noise, some of the fears that may be around, and thinking, well, look at the earnings story, look at the macro backdrop. There are concerns, absolutely. But in terms of the data that we're getting through from companies, we still have some confidence that this economy can continue to perform, and companies across a broad spectrum can also continue to perform too.
Well, Seema, let's talk about some of the good news in the last day or so. ISM Services, a nice upside surprise. Do you think that's a sign of things to come in our future?
I'm not sure it's necessarily a sign of things to come. And when we're taking a step back, we're looking at the economy, putting all the data as much of it as we have, what we see is an economy which is likely to slow down from its current pace. It's probably going to come down sometime during 2026 closer to a trend level. Now, that is okay. It's not wonderful, but it is still an economy that is growing. And so earnings can continue to do well. The more concerning picture, of course, which we have to take more notice of, and of course the Fed is going to be debating so much, is really around that labour market picture. So when we're talking about our forecast, we are building in the assumption that the Fed is going to continue to deliver some rate cuts in order to make sure that whatever weaknesses there is in the labour market aren't allowed to accelerate. So a lot of it is actually resting on this assumption that there continues to be some support coming in from policymakers.
Seema, this really goes to the contradiction of the moment where you're talking about maybe a slowing in the economy. Some people are talking about a reacceleration in the economy, but not necessarily in the labor picture. In other words, a reacceleration of profits from companies that are getting nimble with using AI and other efficiencies of scale, while people are not finding jobs as easily and wages are not keeping pace. As an investor, does that make you more reluctant to invest in the United States? Or frankly, does it give you confidence in the corporate dynamism story of the United States, regardless of what happens to the underlying jobs economy?
It's such an important question, Lisa, and I think that question is coming about sooner than people have been anticipating. I mean, ultimately, we're in this environment where the structural impact of AI, both on labor, on wages, and then general growth, and essentially the bifurcation between what's happening in the labor market and earnings growth. And it's making it really difficult to try and decipher what the new structure of the economy is, what the impact is, and also how the Fed is going to be responding. In this backdrop, we have to go with, I think, clearly diversification, but still this focus on the US because it continues to be the most robust. The companies with the strongest balance sheets continue to play out in the US, but also at the same time thinking about where else can we deploy to ensure that we are maintaining some kind of diversification against a risk that things do start to turn a little bit more negative, both from a cyclical side and, of course, on a structural side too.
So in other words, the sell America trade is over. It might be diversified around the edges, but the U.S. still is the place that is supposed to be the growth engine for the world. Is that correct?
That is exactly right. So we continue, we have skepticism, some concerns, I think healthy skepticism around the AI story and how these companies are ultimately going to deliver. But we do believe in the narrative. If you believe in that, then really you should still be focused on the US. Other countries around the world, specifically Europe, for example, just doesn't have the same kind of prowess. Now, at the same time, because of those concerns around AI, having some diversification in companies across Europe, ones that maybe can leverage on some of the structural benefits that could come out from AI still, but the other parts of the cyclical story is important. And then, of course, across asset classes. So it's not just about regions, but it's about asset classes, equity, fixed income, infrastructure, some areas that you can feel some safety in this kind of environment.
Seema, can we finish on trade? Some key players on the Supreme Court sounding deeply sceptical of the president's broad sweeping trade effort. It remains now, I think, the consensus view coming into Thursday that these tariffs won't last. They'll be struck down by the Supreme Court. How well priced is that story? How well understood is it?
I'm not sure it's necessarily very well understood, but I think what the market is assuming here is that even if they're struck down, the Trump administration will find alternative avenues. So we do, for example, think that trade tariffs are ultimately going to rise a little bit further from here, even in the event that they're struck off. I think the bigger question mark is something you've been alluding to just earlier, which is what is the near-term impact in terms of revenues from the fiscal story, and what is the impact on the bond market going to be? I think that's going to be really the focus for the market over the coming months with regards to that trade story.
Seema, thank you. Seema Shah of Principal Asset Management with the latest on trade there. I think that's the difficulty for the hearing at the moment for the Trump administration. If you keep touting the revenue, you're undermining the national security rationale, which is the broader conversation that was taking place yesterday.
It really raises a question, is this an economic stopgap measure, or is this something that really is an emergency act that does make the president have to do this? It also highlights how important it is, and the justices are aware of this, what kind of remediation happens. And you were talking to this. Do companies get payments back from the government with interest? Is there some sort of process? And can the U.S. government come up with another regime of tariffs to replace it in between some of these deliberations?
You're better at this than I am. Do you really think the Supreme Court would prescribe some kind of refunding process? Or are they going to leave that to other people to come up with?
They'll leave that to other people to come up with. They're not in the business of that. At the same time, it's going to affect how much they wholesale overturn this, right? It's not clear that they're going to absolutely repudiate the tariffs. They could repudiate sections, send it back to lower courts, throw some more sand in the gears while this continues to grind on. That's sort of the reason why people are having a hard time pricing this.
Just going to reintroduce all that volatility from earlier this year. Just can't move on. Equities at the moment on the S&P attempted to move on, just about positive on the session so far. With an update on stories worldwide with your Bloomberg Brief. Joining us now, Yahara Anand. Hey, Yahara.
Hi, John. As you all were just discussing, the Supreme Court cast fresh uncertainty over President Donald Trump's tariffs, suggesting he may have overstepped his authority. In a nearly 3-hour hearing, the court hinted it was ready to put significant limits on the president's signature economic policy. Chief Justice John Roberts called the tariffs an imposition of taxes on Americans. Meanwhile, NVIDIA CEO Jensen Huang says China is going to win the AI race. In an interview with the Financial Times, Huang cited Beijing's lower energy costs and looser regulations. His remarks come after President Trump upheld a ban on NVIDIA selling its most advanced chips to Chinese customers. And Apple is set to be nearing a deal with Google to overhaul its Siri voice assistant. Sources telling us here at Bloomberg the companies are finalizing an agreement that would see Apple pay roughly $1 billion a year for access to Google's technology. The iPhone maker wants to rebuild Siri's underlying tech and roll out new features next year. That's your Bloomberg Brief, John.
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, tariffs saving the world.
If I didn't have tariffs, we would right now, the entire world would be in a depression. Because, that wasn't a threat against us. That was a threat against the entire world. I did this for the world.
We'll get some thoughts on that in just a moment. The former White House trade official Kate Kalukowicz joins us next. From New York City this morning, good morning. Better economic data in the last 24 hours, together with a sceptical Supreme Court, unlocking some gains in the equity market. Those gains continue just about on the S&P, up by 0.1%. On the Nasdaq 100, just about unchanged. Tariffs in focus down in Washington, D.C. Under surveillance this morning. Tariffs saving the world.
I heard the court case went well. It would be devastating for our country if we lost that. Devastating. I think it's one of the most important, maybe the most, but one of the most important cases in the history of our country. If I didn't have tariffs, we would right now, the entire world would be in a depression. Because, that wasn't a threat against us. That was a threat against the entire world. I did this for the world.
European officials watching this, Canadians waking up. I wonder what they think about that this morning, Bramo.
They want to say, thank you, Mr. President. That's, I'm sure, what they want to say.
Thanks for those tariffs.
Yeah, thanks for those tariffs. They saved us.
Here's the latest this morning. The Supreme Court appearing skeptical of President Donald Trump's tariff policy. Several judges questioning his use of emergency powers. Bloomberg's Mike Shepard joins us now for more. Shep, that wasn't a good day for the White House.
No, it sure wasn't. Tariffs have been a pillar of the president's strategy for remaking the way the U.S. engages with the global economy, and he is facing the prospect that the Supreme Court could be knocking it down altogether. Now, he does have some other tools in his arsenal when it comes to tariffs. He could resort to other mechanisms under U.S. law, but this emergency authority that he was invoking under a 1977 law that doesn't even mention the word tariffs was something that provided the immediacy that he had wanted. He really wanted that shock and awe that we saw back in April on so-called Liberation Day, that he would be able to send a message to the world. So instead, as they look for a plan B in the event of an eventual loss at the Supreme Court, they are facing potentially more procedurally driven efforts through Section 232. That's the process, John, that they are using now to impose those sectoral tariffs on autos, on steel, and perhaps soon on semiconductors, too. And this is the kind of thing that, for Trump, it doesn't work as well politically. It's harder for him to translate that into a resounding message the way he did back in April. And it also raises the question, as you and Lisa just noted now, what do U.S. trading partners think? Are they going to use this as some leverage to maybe claw back a little bit of what they had given to the United States during trade negotiations over the past several months? And it's especially important when it comes to China. The relationship with China has been bitterly fought, especially this year when it comes to trade, when it comes to those questions of rare earths and technology export controls. And how will Beijing react once it sees a possible loss in the Supreme Court, and will it change their equation in terms of what they're willing to give back in those talks, which remain ongoing and we will see unfold over the coming year, John?
Shep, they've got the tools to deal with China. I think we saw that in the president's first term. I think what's more interesting about this is everybody else, the Europeans. Justice Barrett yesterday, Spain, France, really? That was basically the conversation. Do they need to tighten up how they talk about tariffs? Because they've gone around touting the generated revenue they've seen of the year so far. And the argument yesterday was just ignore that. That revenue is just incidental. That's not what this is about. This is about national security.
Well, you're right, John. And this whole question of what are the tariffs for came up during the arguments yesterday. We heard the Solicitor General of the United States, John Sauer, talk about tariffs as a regulatory mechanism. And yet we heard again and again the justices come back at the question of revenue. Is this not being used for revenue purposes as well? And shouldn't Congress, therefore, which has the power of the purse, step in and exercise that authority rather than the president? And this is something that we have even heard administration officials outside the Supreme Court courtroom invoke. They have talked about how tariffs are bringing in revenue and how they will help close the deficit and how they may make up for whatever revenue may be lost as a result of the tax cuts. And we did see about a 2% reduction in the U.S. deficit from the tariffs earlier this year. So this is something we'll have to watch for, John, is how they play the messaging going forward and how they move toward a plan B here.
Hey, Shep, thank you, sir. We'll catch up with you again later on this morning. The former White House trade official, Kate Kalukowicz, has this to say. Irrespective of the ruling, there are other mechanisms at the president's disposal that can be leveraged to enact his trade and tariff policy. Kate joins us now for more. Kate, welcome back. I'd just love your initial reaction to what we heard yesterday from some key players on the Supreme Court.
Well, it's hard to ignore that the justices seem poised to rule against the president in this trade action. I think leading up to yesterday's arguments, of course, we saw the president and his surrogates, the Treasury Secretary, the USTR, the Commerce Secretary, all expressing very bullish and optimistic viewpoints that the court would rule in their favor. But yesterday was not a great day for their case.
Kate, can you give us a sense of the range of potential rulings that the Supreme Court could come out with if they do essentially rule against the White House? In other words, what's the range of everything from just saying these are illegal, stop it, just return all the money, which the Committee for the Responsible Budget estimates at $90 billion, or, hey, take a look, try to figure out remediation plans, let's discuss, come back to us in 6 months?
Well, that's the big question, I guess. I think many of the courts, even some of the lower courts, have signaled that there are some medium-term things that the White House could do to offset some of these IEEPA tariffs. They could do a couple things, actually. They could say to the president, well, tariffs are not something that you can do, but you can use another policy. You can enact import licenses and quotas to restrict imports. This is this question about whether the tariffs themselves are allowable to regulate commerce or whether he needs to use another authority. They could look at the individual tariffs, the tariffs on China, which were justified because of a drug crisis. This may be allowable under the IEEPA statute because it's more related to a national emergency than, say, a trade deficit. So I think there are different outcomes here, ranging from a full refusal for the president to use this statute to enact tariffs to some sort of moderated viewpoint, which enables him to maintain tariffs in some cases, but not in others.
Kate, John was talking about the winners, at least in the stock market, in the wake of some of the commentary out of the Chief Justices yesterday, or the justices more broadly. And I'm just wondering, from the client conversations that you're having, what we saw in Lululemon, what we saw in Mattel shares, is that sort of representative of the mood and, frankly, the approach among your clients and how they plan to address this, tackle this, plan for this type of ruling in the near future?
Well, I really try to caution my clients not to approach this as a massive win, because the reality is the tariff environment is going to continue to increase. The president, the irony of the IEEPA tariff is that in many cases, it's the easiest tariff to put on, but it's also the easiest tariff to remove. This is a tariff the president likes to use for leverage. And so by nature, it's not necessarily a long-term tariff. He threatens exceptionally high levels, in some cases imposes them, but very quickly reduces them. And so this does create a lower tariff environment. If he loses the IEEPA authority, he will start to rely on some of these other authorities Congress has given him, the Section 232 tariff on critical sectors, Section 301 tariff, which enables him to hit foreign countries. And these may take longer to impose, but they are much more durable and long lasting. So the outcome really could be a worse tariff environment, not a better one.
Okay, just to finish up, you've been in the room negotiating on behalf of the United States of America in the past under the current president. Can you tell us, Kate, just to what extent this will compromise negotiations in the months to come with other nations?
Well, I think it might. I think that the president's power here very much enabled trade negotiators to get in and exact very important concession, because trading partners took the president at his word that he would impose tariffs with speed and with punishment. And so that helped U.S. negotiators seek gains that I think benefited U.S. companies in foreign markets. That said, the president, as I just mentioned, still has so many tools that he can impose. The 232 tariffs, for example, on automobiles, I think are much more important to trading partners like Europe and Japan and Korea than the IEEPA tariffs ever were. So I think our trade negotiators are still going to have quite a lot to negotiate with as countries seek to get preferential access to the United States market.
Kate, appreciate it. Appreciate your experience as well. The former White House trade official, Kate Kalukowicz there. The message is ultimately that if you like tariffs, you shouldn't be too concerned. We'll find other ways. And if you don't like tariffs, don't get too excited.
Basically, they're going to find a way to raise tariffs one way or another. The question is how quickly, and what is remediation of any potential ruling on tariffs that have already been levied?
John Lieber of Eurasia Group is going to join us in the next hour on that. Look out for that conversation. In just a moment, we'll catch up with Sarah Senator of Bank of America, with the restaurant sector raising alarms on the state of the consumer. That conversation up next. Bouncing back from a day of losses in yesterday's session on the S&P 500, thanks to the economic data and a few other things as well. ADP, ISM, some deeply sceptical key justices on the Supreme Court helping things out as well. The Nasdaq 100 up by 0.1% this morning. On the S&P 500 up by 0.1. Let's turn to the bond market. 2s, 10s and 30s look a little something like this morning. Yields lower by 2 basis points on 2s and 10s. Yesterday, much higher than that. We're back at about 413 on 10s today. Lisa, we talked about this briefly. I think it's worth discussing again. How much of yesterday's move was about the economic data? How much of it was actually about the Supreme Court?
And the answer is yes, because what you got was a 1-2 punch. On one hand, you got the ISM services data with activity expanding at the fastest pace in 8 months, with prices paid increasing. You saw that component increase in contrast to what we saw in manufacturing. At the same time, you also had this prospect of the United States having to return some $90 billion in tariff revenue should the Supreme Court overturn the tariffs under the IEEPA Act, which seem to be a reality.
Next meeting at the Federal Reserve, middle of December. Good luck to them. You're not going to settle your debate. There's not going to be enough data between now and then to settle that debate. Whose mind are you going to change in the next 6 weeks?
Even if you had the data, you wouldn't settle that debate. And I think that that's what people are struggling with. Not only do we not have the hallmark non-farm payrolls report, but the fact that we're seeing a market that's incredibly confusing is just supported again and again. Frankly, U.S. services data yesterday highlights this. It had a stagflationary tilt. You saw a contractionary type of feel in the employment market, even as you saw prices increase and service activity expand. So how does the Fed deal off with that?
Got more estimates for payrolls on Friday, by the way.
I saw surveys coming out.
We got some new numbers, 17 estimates now for payrolls Friday, a number we won't get, and they range from anywhere between positive 80 and negative 99.
Yeah, and so what's going to be the check for that? Do they just get together and just sort of throw bets in?
I think it does say something. You can drive a truck through the estimates right now. No one's got any idea where this labour market is.
But as you've said many times before, we also don't know what the reaction function is, and we don't understand if the emphasis is on the headline figure or whether it's on an unemployment rate, to try to understand whether this is a supply issue, whether this is a demand issue, whether this is just a changing economy.
It doesn't help that the Fed chair changed his mind a couple of times over summer. 2-year bond yields this morning down by 2 basis points, 360 on 2s. With an update on some single names, some morning movers. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Qualcomm is the latest name failing to live up to sky-high expectations. Shares are now down 2.8% in the pre-market, despite beating on both profit and revenue forecasts due to strong demand for its chips and Android phones, and despite showing signs that the CEO's push to diversify into everything from cars to data centers is starting to pay off, but not fast enough for Wall Street. Meanwhile, moving on to Snap, those shares are soaring more than 20% now in the pre-market on a new $400 million partnership with Perplexity AI that will see Perplexity pay Snap to bring its AI search engine to Snapchat. It also came as Snap posted solid user growth, all of this breathing new life into a stock that had been down more than 30% this year going into the earnings. And we end on DoorDash, those moving to the downside, down 10% now after the delivery giant said that it would boost spending, hitting profits. That's despite what was otherwise a strong quarter, with gross order value posting its biggest gain in over a year, showing consumers are still willing to pay for convenience. Interesting after all we heard from those restaurants these past 2 weeks. John.
Yahara, thank you. Are we testing the limits of investor patience? It's just data point after data point adding up here. Started with Meta last week, and it's just been one after the other so far this week. We've been rewarded spending for a long time. The pushback started. You've got to take note.
Yeah, and the pushback is coming not because spending in and of itself is bad. The pushback is coming because people want to show me the money. They want to see the returns on it, and they want to see the revenue growth, the profit growth increase in tandem with the spending. That's not always happening, which is why you're seeing people rely on the bond market more.
Futures doing okay this morning on the S&P 500, just about positive. On our radar this morning, this story right here. The U.S. Supreme Court appearing skeptical of President Donald Trump's sweeping global tariffs. Key justices questioning if he overstepped his authority. A decision against the tariffs could force more than $100 billion in refunds. Elsewhere, Transportation Secretary Sean Duffy predicting, quote, mass chaos with air travel as the record-breaking government shutdown continues. Starting Friday, the U.S. is cutting flight capacity to alleviate pressure on air traffic controllers. And finally, this caught my eye. NVIDIA CEO Jensen Huang warning that China will win the AI race. Huang telling the Financial Times that thanks to lower energy costs and looser regulations, China is poised to surpass the United States in AI development.
You know, Jensen Huang has come out earlier and said that China is right behind, nipping at the heels of the United States when it comes to the advancement of tech. How much does this come because he really sees China getting the upper hand on some of these subsidies for energy in particular? How much is this a repudiation of President Trump's move to not allow NVIDIA to sell the Blackwell chip into China? There has been an argument that he has made very loudly, which is that it is a national security issue for the United States to remain relevant around the world when it comes to technological prowess. Is this his lobbying effort to say, you are setting us behind if you continue to prevent us from selling Blackwell into China?
I don't know what the intent was. Nobody does apart from Jensen himself. But I can tell you how it looks, and you're describing it pretty well. The tech grift needs to be called out. You're trying to influence policy of the United States of America. And the Wall Street Journal reported on this pretty well in the last week or so, that it actually was the State Department that managed to convince the president not to talk about Blackwell chips with China. And there was a real risk that maybe Jensen Huang was having more influence over policy around that specific item than maybe Secretary Rubio himself was. That's a concern. I'd throw in OpenAI as well in the last day or so. I saw comments coming from OpenAI talking about government guarantees to some of the build-out. They're all trying to get the government to get more and more involved in this build-out. For anyone that favours free and open markets, they should be very concerned about the influence that we're seeing coming from some of these major firms on policy.
Yeah, there's also a real question here about what government involvement should be. I mean, you think about the whole Belt and Road Initiative, but also this idea of building out and subsidizing some of the efforts in China. Does that give China the upper hand? I mean, this is actually a real question, whether Jensen Huang is the right person to be a credible narrator of that argument, given that he has so much skin in the game. I'm not sure. Nonetheless, a really interesting headline over the past 24 hours.
Very, very interesting. The latest there from the Financial Times. Let's turn to the consumer. They appear to be losing their appetite for fast casual restaurant chains, including Chipotle, Shake Shack and Cava. Sarah Senator, senior restaurants analyst at Bank of America, joins us now for more. Sarah, welcome to the program. Is it just those names, or are you seeing this across the industry?
Thank you for having me. And it's much broader, I think, than just those companies. You know, we have seen softer performance or softer demand from lower income consumers. That's been happening probably for the better part of the last 2 years. And now we're really seeing evidence that it's broadening out and rising up the income spectrum to more middle income households as well. So this is a much broader issue than just the fast casuals, I think.
Sarah, let's talk about price. I was looking back at some of the transcripts from Chipotle, the more recent one from the earnings and the one back in 2021. And the issue on pricing, the difference, it's just stark. It's massive. They were talking recently about putting prices up in California by 1 percentage point, and they saw pushback. Sarah, just how much has changed in the last 4 years?
I think one of the things that has changed, certainly besides the softer economy and just the softer consumer demand overall, is certainly we've seen inflation come down, and that typically means that restaurants aren't able to take prices higher. So, consumers are very cognizant of when pricing changes. They're looking across their budget. They're looking at grocery stores, and they really know when relative pricing changes. I think Chipotle has actually done a very good job of maintaining its pricing at a fairly low pace. But this isn't 2021 or 2022 anymore, where restaurants can take prices up mid-high single digits. This is a new reality in terms of both the demand and the pricing environment.
Sarah, how much is this a cyclical issue of the consumer really pushing back, and how much is this really an existential question to a lot of the fast casual restaurant chains out there that have lost share? You've actually seen spending elsewhere when it comes to restaurants and eating out do better than this particular cohort. Is there something else going on about quality and value and the concept of that's transforming the way that some of these companies have to compete?
I tend to think it is still the former, right? So, we know that demand has softened. It wasn't that long ago that these fast casual restaurants were posting, same store sales in the mid-teens, high teens, even, high 20s in the case of, for example, Wingstop. So I don't think that this is a structural shift that's happened overnight. I do think, like I said, this is a slightly higher ticket item. And we have historically seen restaurants that have benefited from trade down, sometimes now seeing trade out. So consumers are just not eating out. We heard from McDonald's yesterday talking about how the low-income consumer transaction growth is down high single digits. That's for fast food. The middle-income consumer, we know that cohort transactions have also declined. So I really do think this is a broader issue with the consumer that we're seeing. And it may be manifesting most visibly in some of the fast casuals, but it's not exclusive to them.
McDonald's also talked about how they don't see the consumers really picking up or for there being a better backdrop in 2026. Does that make you pretty bearish on the whole sector just generally because this is a story that's not going away?
I mean, I will say, this is a sort of a Pyrrhic victory that we have because we have said that for a while now that, the lower wage growth, the lower demand growth among, lower income cohorts, that's not something that typically turns on a dime. In the past, when we've seen this, it's happened for, it's persisted for a few years, this divergence between higher income consumers who are still spending, the demand in that cohort is a high single digits. So kind of a almost perhaps 20 percentage point gap between high and low in terms of demand growth. And that's been going on. And historically, what we've seen as patterns suggest that will persist. Certainly for quarters, if not, a couple of years.
Sarah, have you got a top pick? Is there anyone in the sweet spot, just relatively speaking?
One of the stocks that has actually performed where we've seen demand grow is Starbucks. Most people think of coffee as being more cyclical, that we just really haven't seen a lot of evidence of that. We saw Bros report last night. Their same-store sales were also quite healthy. So that seems to be a category where consumers, even younger consumers who are under pressure, are willing to pay for the experience.
They just won't give up their coffee. Sarah, thank you. Sarah Senator there of Bank of America. Appreciate it. Are we testing the limits of consumer price tolerance? And is there evidence there in the restaurant business? And how instructive is it for this Federal Reserve? We discussed this before. For Governor Meyer and for Governor Waller, is that a decent enough argument for them to convince some of the hawks on the committee not to worry about inflation and to focus on labour? I
thought you were just going to come out and say the note to all of these fast casual retailers is just put crack cocaine in your different things, make caffeine in there, make people hooked. I mean, that's essentially what it has to be. Look, I think you're right, though. And the question is, would a Fed rate cut actually help people at the lower income sphere more than it would inflate a bubble and threaten financial stability on the other side? Does it help or does it exacerbate the K-shape that we keep talking about?
I may have recommended some crazy things in the past, but crack cocaine into your beverage in the morning would
honestly,
be one. Okay?
Like caffeine is sort of the same thing for me. I'm going to just move on now.
Okay, just to be very clear on that, all right? Any children waking up this morning? No. Okay, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Billionaire Ken Griffin saying he wants to see the newly elected New York City Mayor Zohran Mamdani take a different stance than the one he campaigned on. Griffin hoping the self-proclaimed Democratic Socialist will think about the right role models when he thinks about leadership, saying, quote, the people of New York deserve better. Meanwhile, the French government says it will suspend Chinese e-commerce platform Shein after complaints about the sale of weapons and childlike sex dolls on the app. The suspension will affect Shein's online marketplace and not its physical store in Paris. Shein says it hopes for discussions soon with French authorities. And Peloton is recalling more than 830,000 of its exercise bikes over safety concerns. The Consumer Product Safety Commission saying the bike seat can break during use, posing a hazard to riders. Consumers are being told to stop using the bikes immediately and contact Peloton for a free repair. That's your Bloomberg brief, John.
Yahara, thank you. I just got some painful images as Yahara's going through that story.
I mean, the seat breaking and then the parts. I mean, this is a pretty sensitive thing. I think this program is just going pretty
off the rails in the last 5 minutes or so. All right, let's get it back on the rails if we can. Up next on the program, financing the AI boom.
AI in the broad ecosystem, you have to think about debt and equity returns on invested capital. You're taking more residual risks than you did 6, 12, 18 months ago.
That conversation up next with Maureen O'Connor of Wells Fargo, live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Your scores look like this morning. Equity futures on the S&P 500 just a touch higher, up by 1/10%. On the Nasdaq 100, up by 0.07%. Under surveillance this morning, financing the AI boom.
AI in the broad ecosystem, you have to think about debt and equity returns on invested capital. You're taking more residual risks than you did 6, 12, 18 months ago. With valuations as high as they are in this cycle right now, you have to take a step back and pause and say, okay, do I want to be a lender? Do I want to be an equity owner? What's the residual value assumptions that I'm making? That's really what will differentiate the winners and losers.
So here's the latest this morning. The record-breaking rush of debt issuance to power the AI arms race, raising questions about long-term risk and potential returns. Maureen O'Connor of Wells Fargo writing issuance out of the large-cap tech companies, as well as the U.S. utilities, will be a tailwind for issuance over the next 2 to 3 years. Maureen's in the studio here in New York. She joins us for more. Maureen, good morning.
Good morning.
Hey, it's good to see you. Let's just talk about how busy you've been over the last month, how that stacks up with the rest of the year, and the ramp you're expecting to see in 2026 and beyond.
Yeah, well, so we've had an exceptionally busy run. We are probably looking at a record November for high-grade issuance volumes by a pretty big margin. A few things driving that. Number one, market conditions are still pretty favorable here. Spreads are relatively tight from a historical perspective. We have backed up recently just with some of the heavy supply overhang, but we're still very close to cycle tights in terms of spreads. Treasury yields have come, 60 basis points lower from the peaks we saw in the early part of the year. So from just an issuance window perspective, it feels like an advantageous time to get in front of some of your 2026 funding needs, and that's what we're seeing. But on top of that, you obviously have this undercurrent of CapEx spending that needs to get financed, and that is going to be a tailwind heading into next year. So while we are looking at probably $150 billion of volume for November and maybe somewhere around 1.65, 1.7 trillion in terms of total full year supply, next year could be somewhere closer to 1.8, 1.85 trillion. That would be likely a record year for our market, rivaling that 2020 kind of COVID liquidity rush we saw.
So we had 50 billion from just two names, almost 50 billion in the last week. Is a smaller number of companies responsible for a larger amount of that issuance?
Yeah, so obviously tech supply is quite topical. The number is actually slightly larger than 50 when you consider the non-dollar component. Sure. Alphabet did do a euro in addition to dollars, and then you also have project finance bonds that have come through our market. So the number is actually a lot larger than that when you kind of take it all in totality. But when you look at sort of tracked tech issuance, will be somewhere around 200 billion this year. Next year, that number could increase by something close to 75, maybe even 100%. So for sure, capital expenditures is going to be a tailwind, for issuance as we head into the next kind of 2 to 3 years.
So far, concentration has been a feature, not a bug, of the equity market returns. Do you get investors that are getting increasingly concerned about concentration risk in the investment-grade debt market as a heavier component becomes these tech companies?
Yeah, so I think first and foremost, when we look at these companies fundamentally, these are mega cap, highly rated, cash-rich names with typically low net debt. Their debt footprints up until this point have actually been somewhat modest relative to their market cap. But obviously, as they become bigger components, their debt footprint grows in bigger components of the index. You're going to start to see the market price that risk. But they're still a far cry away from being as large as, let's say, the U.S. big six banks. J.P. Morgan, B of A, Wells Fargo, these are the largest index weights right now. So there's a long way to go before we reach sort of a saturation point. And banks fund regularly in our market, albeit at slightly wider spreads than where the index trades. So I think ultimately our market is prepared to take down a lot of concentration risk, but it probably gets priced into spreads over time. So said another way, these names will likely trade a little bit wide relative to their ratings as their CapEx needs expand over the next 2 years.
Putting this another way, is this a window where things are priced to perfection, so you might as well get in while the getting is good?
I think you are seeing a little bit of that. I think that's what's explaining a lot of this November rush right now. The getting is good right now from an industry perspective. Spreads are still very tight, but also from a macro perspective, the world feels pretty good right now. There's a lot of uncertainties as we head into next year. So I think you are seeing a lot of folks get in front of what they anticipate their funding needs will be in 2026 and de-risking those plans now.
The world is changing rapidly. Something I've been confused about for a long time. Help me understand. Why does anyone want to buy 50-year debt of a tech company? Can you explain that to us?
Yeah, I mean, I think it also goes back to the strong fundamentals I was just alluding to. A lot of these companies are very highly rated, right? AA rated risk. And even if we do take on a large amount of leverage, most of them are not in danger of threatening those AA ratings. So I think, from a fundamental perspective, these are still considered pretty safe investments. But more than that, there's a technical component to long duration supply in our market. A big component of who buys corporate credit is going to be liability driven investors. These are pension funds, these are insurance companies, these are investors that are matching their assets against their liability streams. naturally these folks lean longer on the curve, and our market had been undersupplied in long duration to a huge degree up until basically the last week or so, where the market's gotten a lot of long duration. So there was a pent-up demand for long end paper heading into this wave of issuance that has supported a pretty tight spread environment. Over time, could we see spread curves steepen? I think the answer to that question is probably yes, as these companies increasingly rely on very long-dated debt capital. But for now, there is such a strong technical base in our market supporting that bid for long duration that I think a lot of these companies will be highly successful funding these capital expenditure
Can you
needs.
give us a sense of how many coupon clippers there are versus fast traders versus fast money? I mean, just to get a sense of how much pricing risk is in some of these markets. Yeah, I can imagine an insurance company just wants to match the liabilities. They're going to clip the coupon. They're going to like that income for 50 years if we still are using search and if we still are using iPhones and we don't just have a chip planted in our brain. Well, I mean, it's just that when technology is changing this quickly, it's very hard to say that this is going to be a AAA rated company or a AA rated company in,
I'm right there with you.
I can't even read 2075, but I am curious, how much is this fast money coming into this market and how much really is that institutional coupon clipping buyer?
Yeah, so when you look at the composition of who buys investment grade debt, roughly 30% of our market is pension funds and insurance companies, and that's just in the U.S. Then you also have a foreign component that buys U.S. dollar-based fixed income assets, and in that number is also a lot of liability-driven investors. So the number is probably closer to half of our market are more yield-focused investors. Then you have a component of more of this kind of total rate of return money, ETFs and mutual funds, makes up about another 30-ish% of our market. And then, of course, you have the more actively traded funds, which are a growing component of the overall landscape in fixed income. On a primary basis, hedge funds account for about 10 to 15% of allocations in new issues.
Are we still doing this show in 2075? I hope we're still around.
You think that we're 50 years, I'll come out and
Are we still sitting here, Bramo? As that matures?
Good morning.
As that matures, I'll still be here.
Yes,
Maureen, I just want to finish on this, on a supply issue. How much competition is this for the issuance on the Treasury side? How much does one compete with the other? Because what was interesting for us following the Alphabet issuance, when that came out, it felt like Treasuries were getting kicked around at the same time. Does one compete with the other?
You'll find that the markets are pretty bifurcated. Usually from an asset allocation perspective, there's not a lot of fluidity between those two markets necessarily. People will have a fixed income allocation and it will be, spread across a multitude of different products. Obviously, treasuries, corporates, but also MBS, ABS, et cetera. The pressure that we saw in Treasury yields at the beginning of the week was a result of some of the response to the Fed meeting last week and then the refunding announcement. So I think it's really more macro factors driving Treasury volatility than it is about corporate debt issuance.
Maureen, this was great. Let's do it again soon. Don't wait for that bond to mature. Okay? Maureen O'Connor of Wells Fargo. We're going to see a lot more of this to come through next year, if those numbers are anything to go by.
You're planning to wake up at 3 a.m. every single day until
I love this,
you're,
Bramo. 90 years old. I can't wait to do that.
And this is going to be really something.
Be
2075,
right,
you're going to be like...
crumbling.
Can you imagine? People don't even get news at that point. They just put a chip in their head.
I don't know what's going on in 2075. Which begs the question, why would you want to... Yeah.
Can you imagine? We'll all just have vibes inputted into our heads. And the robots are going to control everything anyway.
By like Elon's kids or something. Because that's who's still around at that point, right? They're just plugging in the vibes.
Yeah, exactly.
Is that how this works?
So we just sort of,
My goodness, I don't even want to think about that. Coming up next, Bob Dole of Crossmark Global Investments, John Lieber of Eurasia Group, former Kansas City Fed President Esther George, Brad Rogoff of Barclays, the second hour of Bloomberg Surveillance. Up next.
We're seeing a much larger theme of a strong economy.
The growth of the economy is probably accelerating.
There are still a lot of inflationary catalysts.
We're not worried that this is the start of a new inflation cycle.
The economy going into 2026 looks okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 pretty stable at the moment, almost positive by 0.1% following yesterday's gains. On the Nasdaq, just about unchanged. In the bond market, bond yields across the curve, 2s out to 30s yesterday, pushing higher. This morning coming lower. We're down 2 basis points at the front end of the curve. On 10s, we're down by 3. 4.13 on a 10-year bond yield, and a ton to consider. Lots of economic data, I should say conflicting economic data, and the prospect of an interesting Supreme Court decision taking place before the turn of the year.
On one hand, yesterday, people were taking a look at the ISM services data with volume and activity accelerating to the highest pace going back 7 months and saying, wow, why should the Fed cut rates anytime soon? And then the potential for the Supreme Court overturning the tariffs raised a specter that U.S. revenue from tariffs would be excised from the balance sheet, also bond negative. That said, all of the earnings that we have gotten from fast casual restaurants have pointed to a consumer flat on its back and a K-shaped economy where one side of the K is really not doing well, and that is making it very difficult for the Federal Reserve.
We've talked a lot about division at the Federal Reserve. Division, it's so divided. Check out the Bank of England. Decision just crosses, leaving interest rates of 4%. The estimate was 4%. A 5-4 vote for this one, Bramo. A 5-4 vote. That's what division looks like at a central bank.
Yeah, and this is what a difficult decision for a central bank looks like when you have a budget that isn't working, where essentially bond yields are creating a real liability and creating a debt spiral that is very much a doom loop. What you are seeing is the pound respond just a little bit, but highlighting just how difficult it is for the members of the Bank of England to have agreement. Some people might say this is great. Look at the disagreement that you have. It also shows they've lost the plot. They're just responding and being buffeted by political decisions, geopolitical decisions, and frankly, structural issues that they cannot solve.
A slight difference with the Federal Reserve, almost the opposite of what we saw from the Fed just last week. The Fed cut interest rates, but couldn't guide. The Bank of England doesn't cut, but almost guides to cutting in the future. The Bank of England essentially saying that rates remain likely on a gradual downward path, and the overall risk to inflation now are more balanced. That's a different tone, a different set of guidance coming from this institution compared to the Federal Reserve.
They're also facing off with a very different economic backdrop. The Federal Reserve is trying to justify cutting rates into an economy that a lot of people say is accelerating, whereas in England, it is a very different economic backdrop where you're seeing downgrades to the economic prospects from the main budget office at the same time that debt rates are rising.
We'll have more on that decision in just a moment. Coming up on the program, Bob Dole of Crossmark Global Investments as the equity rebound appears to stall. John Lieber of Eurasia Group with the government shutdown forcing flight cuts, and Brad Rogoff of Barclays as a global bond rush breaks records. We begin with that rate decision from the Bank of England. Bloomberg's Lizzie Burden joins us now from London for more. Good morning, Lizzie.
Morning, John. Yeah, it's a hold at 4%, as economists had expected. It's the safer bet, as you say, given that we've got a budget coming from the Chancellor Rachel Reeves on November the 26th, and given that CPI inflation at its latest reading was 3.8%. But this vote split, as you say, was really a tight one, 5-4. We expected Swati Dhingra, Dave Ramsden and Alan Taylor to vote to cut, but the surprise here is Sarah Breeden, the Deputy Governor. And this time we get to find out the thinking behind each Monetary Policy Committee member's thinking. She says now she's more confident that disinflation is on track. Now, in terms of the forecast, the expectation was that they'd cut the inflation forecast for this year and next compared to the August projections. In fact, now they see inflation below the 2% target in the second quarter of 2027, so below the previous forecast. And in terms of the guidance, we were wondering whether they'd keep this language about a gradual and careful approach to cutting rates. They're saying that rates are likely on a gradual downward path and that the overall risks to inflation are now more balanced. So I'm really looking forward to this press conference, John. I'm wondering what the governor's going to say about the Chancellor, because she was firing shots from Downing Street to Threadneedle Street on just Tuesday, saying that having rates at 4% is constraining business borrowing. Some saying that's a bit Trump-esque. I wonder what the governor is going to have to say about the budget, but also how he's going to frame that 3.8% inflation. If you look at the market reaction right now, you've had the pound trimming the gains it had before the decision. So we're now only up 0.1%, but still at $1.30. Gilts have been gaining off the back, and traders have held their easing bets steady. So they're seeing 15 basis points of cuts in December now.
Lizzie, just quickly, what time's the news conference?
We'll be with it in 25 minutes, and we'll have full coverage for you right here on Bloomberg TV.
Wonderful, Lizzie. Thank you. Lizzie Burden there. Over in the City of London, of course, they'll be tracking that Bank of England news conference at 7:30 Eastern time, so about 25 minutes from now. You can watch that if you're in the United Kingdom. For everybody else, you're stuck with us and we're going to talk about the broader market. The view on Wall Street looks like this. The stock bounce on pause following an AI rally. Bob Dole of Crossmark Global Investments writing this. The asset price inflation party will roll on, given that monetary conditions have become even more accommodative and corporate earnings, the prospects for them remain positive. Bob joins us now for more. Bob, welcome to the programme, sir. Always good to see Bob Dole. Bob, let's get into this. So you say things remain constructive and positive, and I hear you. I get all of that. But I'm seeing pushback in the equity market at a single name level. Earnings report after earnings report from companies that have put up decent figures, including the likes of Palantir, and the market has pushed back. How notable is that, Bob?
Definitely notable. I'm 5'4" inside myself. The 5 is things are okay. When earnings estimates are going up and the Fed's cutting rates, stocks go up. The 4 part says but, and the but has everything to do with all kinds of measures of speculation and internal divergences. The advanced decline line, for example, Jonathan, as you know, has been awful the last week or so. So I think we're in for some sort of, at best, sideways action, maybe some sort of pullback, but I don't think the bull market's over.
Bob, at what point is this dissonance between asset price inflation and real price disinflation not sustainable? In other words, is there a time when either asset prices need to come down to where the price increases and the acceleration of inflation really is, or does inflation need to pick up pace?
Good question, Lisa. Look, I think inflation is sticky. The Fed seems to think they're going to get to 2. Chance of that, to me, absent a recession, are close to 0. It's just not going to happen. Obviously, when you throw money at the system, a lot of it finds its way into asset prices, and that's what we've witnessed for months and months and months now. So I think this can go on as long as that liquidity is strong, as long as earnings are strong. To repeat, when earnings estimates are moving up and the Fed's lowering rates, the market hardly ever goes down.
Bob, do you think if the Fed cuts rates, that will allow some sort of broadening out in the participation in the index and that you see asset price inflation with the stocks of consumer-facing companies truly go up, a reflection of a better economic backdrop? Or do you think it will just accelerate what we've seen at the very top, the big tech names continuing to do better, inflate some sort of bubble that people have been worried about?
I think it'll be largely more of the same, Lisa. That is to say, these big growth companies are where the action is. Unlike, I hear so many comparisons to the dot-com bubble, those companies then, they didn't have earnings. Many of them didn't have revenues. Here we have earnings, we have revenues, we have cash flow. We can quibble about the valuations, but I think until this bull market is over, probably these growth stocks lead the way.
Bob, let's talk about everybody else and what that Supreme Court decision might mean for them. Bit of a stress test yesterday. Some deeply skeptical Supreme Court justices, key justices for this administration if they want to get their own way. Bob, your thoughts on what took place yesterday, and ultimately, how do you expect this market to react if the Supreme Court does strike down this broad-based tariff effort?
So, Jonathan, my sources tell me that the president, the administration, has other tricks up their sleeves, other ways to do this. So it wouldn't be pleasant if it went that way, but I'm not sure that any other reasonable circumstances the tariffs are going away. They're here.
The names that otherwise have found it difficult in 2025, we saw a bounce. Lulu's been a terrible stock for 2025, had a bounce yesterday. Macy's had a bounce. Lisa talked about Mattel. Mattel also had a bounce. Bob, to get this market to broaden out, to see that performance broaden out, if they're still able to put tariffs on through different means, different ways, Bob, is it difficult to get that broader story?
I think it is. Outside these short-term moves. Look, we know in the third quarter and to date, the junkiest companies, the companies not making money, have done really well. This market has gotten very speculative. SPACs are back. IPO price from announcement to the close on the first day this year is the best since the year 2000. That wasn't such a good year to be in stocks. Margin debt over $1 trillion. You know the list. So we have some speculation, and that's going to cause a lot of turbulence in the market, not just the market overall, but inside. And you're pointing some of that in your question.
You talk about potential turmoil in the stock market. What about the bond market? This has been one of the biggest threat points that a lot of people have said. Do you expect bond vigilantes to make a rare appearance if there is some sort of court overturn of the IEEPA use of tariffs?
Thank you, Lisa. That is to say, The bond market, too many of us equity folks just ignore it. But, you get rates, the 10-year down under 4% for about a day and a half, and then it starts creeping back up for all kinds of reasons, not the least of which is the dollar has come back to some degree. As you know, they're part and parcel of each other. But I think as long as we're dealing with a 10-year kind of where we are and the fear that it's going to drift higher on yield, that's not great news for stocks.
Bob, it's always good to see you, sir. Let's get you in the studio next time. Bob Dole there of Crossmark Global Investments, still constructive on this equity market. Mike Wilson of Morgan Stanley with us earlier this week, very constructive on the stock market in the past week. And his message is clear, Lisa. He thinks the worst of the news is behind us. The recession was back in April, and since then things have improved. And as the ISM, the start of things to come, ISM services was much hotter than expected, almost across the board.
Yeah, he also was talking about how you could see that rotation back into the cyclicals. In that type of scenario, could you see an index level that actually stays flat or just creeps up a little bit with an underperformance of some of the AI-related names as other companies do better? And that's kind of what you've seen underneath the hood of markets. When we saw a sell-off earlier this week, it was actually one with broader participation and more gainers than losers. So it really raises a question. Is that what we're expecting next year? And is that kind of the recovery that is deeply unsatisfying for some?
The stock market doing OK this morning, positive by close to 0.2% on the S&P 500. With an update on stories worldwide, here's your Bloomberg Brief with Yahara Arnott. Hey, Yahara.
Hi, John. The Bank of England holding its key interest rate steady despite 4 members pushing for an immediate cut. The central bank signaled a gradual downward path for future rates, noting that inflation risks are now more balanced. The BOE also lowering its inflation forecast, expecting it to fall below the 2% target by mid-2027. Meanwhile, Snap shares are rising more than 20% in the pre-market, the company announcing a $400 million partnership to roll out Perplexity's AI search engine to Snapchat users globally. Perplexity's product will become the default search tool inside Snapchat starting next year. And Moderna reporting third quarter revenue that beat expectations, but cutting the top end of its full year revenue forecast. The pharma giant cited a decline in net product sales, specifically COVID vaccine sales, as reason for the revenue drop. Shares are up more than 5%. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, not cleared for takeoff.
Our sole role is to make sure that we keep this airspace as safe as possible. There is going to be a 10% reduction in capacity at 40 of our locations.
Up next, John Lieber of Eurasia Group, live from New York City this morning. Good morning. Stocks are positive this Thursday morning, adding some weight to yesterday's rally, up by 0.1% on the S&P 500. On the Nasdaq, up by 0.11. Down in Washington, D.C., the pressure building to end a record-long government shutdown. Under surveillance this morning, not cleared for takeoff.
I anticipate there will be additional disruptions. There will be frustration. We are working with the airlines. They're going to work with passengers. But in the end, our sole role is to make sure that we keep this airspace as safe as possible. There is going to be a 10% reduction in capacity at 40 of our locations.
So here's the latest this morning. The United States cutting flights across the country to alleviate pressure on the aviation system during the ongoing government shutdown. Mike Shepard tracking the story down in Washington, D.C. and joins us now for more. Shepard, is this the pressure point? Are things getting real now in Washington?
It is getting real, but it has been getting real for a while, John. We've already seen other impacts from the shutdown. We have seen food benefits dialed back and reduced. We have also seen tens of thousands of federal workers furloughed. These are the non-essential workers. And then we have seen essential workers like those air traffic controllers showing up day after day after day and not getting paid. And this is starting to add up. And estimates are that this is costing the economy about $15 billion per week as it drags on. And yes, this is all adding up to a big pressure point, but so far we are not seeing a change in the equation when it comes to the negotiations between Republicans and Democrats here in Washington. After Tuesday's election victories for Democrats, we saw the top party's top two leaders in Congress, Hakeem Jeffries and Chuck Schumer, write to President Donald Trump asking for a meeting with other congressional leaders to try to negotiate a way out of it. But President Donald Trump so far has not taken them up on that offer. And instead, he is urging Senate Republicans to do away with the filibuster rule. And that would allow the party to jam through on party lines the spending package that has been held up by Democratic objections over potential losses in health benefits. That's really at the center here and what Democrats want to negotiate. But we're going to have to see, John, how much further this can go and how much more pain the economy will have to take before leaders on both sides start to move. And we'll see who blinks first here.
Hey, Shep, appreciate the update. Anna Freeman down in Washington, D.C. Tracking the White House and the president, Lisa. Doesn't appear that this is on top of the priority list for them this week. The major one in the last week has been the last 24 hours at the Supreme Court.
There's been more commentary about that. Yes, we are hearing about ratcheting up the pressure, and I'm looking, and if you're leaving any major airport anywhere around the country, you will get delayed at some point. That's basically the takeaway here. Nonetheless, the focus really is, will the primary trade objective get overturned by the top court in the United States, and what are the consequences of that?
This at the moment, just background noise. Of course, that could change, but certainly at the moment, just kind of background noise. John Lieber of Eurasia Group is in the studio here in New York for more. John, good morning.
Morning.
Let's start with trade. How instructive was yesterday's hearing for you and the team?
I thought it was, the justices were clearly skeptical of the government's argument. So if I'm the Trump administration, I'm not feeling great about the fact that the court is going to uphold my signature project right now. And if that happens, there's a lot of uncertainty and questions that generates, such as will there be refunds generated for people who paid the tariffs already? And what's the fiscal path going forward? Because this is $4 trillion in revenue over the next 4 years. They'll be able to recreate that wall through other methods over time. But there's going to be, this introduces a big dose of uncertainty into 2026 on who's getting tariffs. What does it mean for the status of the deals that have been struck with Japan, with Korea, with China, with the UK? And I think the administration isn't offering answers to that right now. They're hoping the court sides with them, but there's at least 3 conservative justices that looked very skeptical of their arguments yesterday. And it does look more like those tariffs will be struck down than it did 2 days ago.
How surprised were you that there was such a definitive tone out of the Supreme Court justices, including those in the conservative bloc of the court, given that pretty much most people were expecting that they would okay this? They would essentially sign off on it as they have other initiatives by the president.
Well, if you look at the lower court arguments, they're pretty solid. I mean, this is the tariffs have raised a number of questions as to the presidential authority. There's questions about whether or not the power to regulate trade includes the power to tax. That's something that Neil Gorsuch was focused on. And then some of these tariffs, I think, are just clearly not related to national security at all. You can't put tariffs on Brazil because you don't like the way they're treating your political ally and then claim that's an economic national security emergency. So I think there's obviously some tariffs here that are weaker, and there are some that are potentially stronger, like the fentanyl tariffs, which you could claim is an emergency.
Is President Trump losing his clutch over the narrative? And I say this given that he really dominated the Republican Party, but now you have conservative-leaning justices talking about tariffs as a tax, which is exactly what he is pushing back against, and talking about things that Democrats have been talking about for a while. Do you think that this is significant regarding a broader shift that you're seeing in the political mindset?
I think it was only a matter of time before we started to see some of the institutions that govern the U.S. come back and bite an executive who's been very active and aggressive in his first 10 months in office. This is his second term. He came in with a plan. He came in with the people in order to execute on that plan. And he's accomplished a lot. He's particularly accomplished a lot in foreign policy. But he's going to run into the limits of his power at some point, and it's the Supreme Court that's the one that's going to be reining him back in. And I think we saw some evidence of that yesterday. I think for investors, this is actually an important signal, because what's the narrative of the U.S. this year has been, is this the U.S. One of the big questions has been, is this the U.S. that we know and love, or is something different now? And I think the institutional constraints on President Trump is a positive sign for the investment community that he can be restrained, that executive power is not unlimited, and that the court still does its job.
Let's extend this conversation. The Supreme Court's job. How far are they going to take this? Are they going to prescribe a refund process? Just how far will they take this?
The refund process is tough. I mean, the Supreme Court in particular doesn't want to be the administrator of a refund process. So there's lots of different ways that this could go. They could say everybody who paid a tariff so far this year gets a refund, and then they all get the money back. That seems unlikely, though. What looks more likely is that the lower courts are going to be charged with administering some kind of refund process, We don't know what that looks like. It could be the case that individual companies have to sue and say, hey, there's this law, it's unconstitutional, it's illegal, we paid the tariffs, we want our money back, and then that works its way through the courts. So that's uncertainty that could go for 6 to 12 months or longer next year for those individual companies, even though we know at a high level that these tariffs are illegal.
There's a guy named Scott down in Washington, D.C. that's going to have to figure out some new revenue. Where's it going to come from?
They got plenty of other tools for raising tariffs. There's Section 122, which allows, I'm sure your viewers have all heard these codes by now, Section 122, which allows 150 days of 15% tariffs. And then there's all these individual country tariffs called the 301s. It's how they're raising revenue on China. And of course, let's not forget that some of the most powerful tools that Trump has are the sectoral national security tariffs, which are the 232. So there's plenty of other tools they have. They just have to go through the process of getting there, and they haven't yet. IEEPA was quick. It give the president a lot of power. It allows him to change his mind quickly. But these other tools need a little more process and a little more time to put into place.
So it's really good to see you in person. And I'm just wondering, when you go back to D.C., are you going to fly there?
I'm taking a train. I'm not getting on a plane right now.
I'm just wondering,
no way.
I'm looking at this and I'm seeing, Ronald Reagan Washington National. I'm seeing LaGuardia. I'm seeing pretty much every airport in every major metropolitan area. Is this a warning shot from the government essentially saying, we're going to raise the ante, we're going to make you feel this to try to push people to the negotiating table sooner?
Absolutely. And I think the real deadline here, it's not today, it's not this weekend, it's Thanksgiving. And you've got millions of American families that are, including mine, that's looking forward to traveling on Thanksgiving on a plane, and those planes better be flying. And so that means the government has to be open by that point. Otherwise, they're going to have a lot of angry Americans out there. So I think that puts a backstop on how long this shutdown can end. That's 2 weeks away. Still got some time here to negotiate, but they better solve this problem by then, or else I'm going to be, down at the Capitol building protesting.
I like that you went to the Washington airports first, because this is about inconveniencing the politicians themselves,
right.
Not about the rest of the country.
I mean, both, to be fair. I mean, it's going to absolutely inconvenience everyone, but they're trying to raise the pressure. Is this going to work? I guess that's my question. Is this going to work on the Republicans' end, given the fact that Democrats haven't borne the brunt of it so far in the polls?
John, can we talk about data? What does data collection look like? Let's say it ends before Thanksgiving, because no one wants to go through that. I can go with that. Let's go with that. I hope that's the case. Yeah. What happens with the data after that?
So, in the past, what they've done is they've doubled up on data releases when they have the data. So they collected the September payroll data, for example. They just didn't release it. They haven't collected the October and if the shutdown goes into next week, they'll probably miss the November household survey as well. And so if they don't have that data, they can't release it if they haven't done the surveys. It's possible they could do the employment survey, because that's electronic, so employers fill it out, and they fill it out over a long period of time. It's one of the reasons we have such big revisions, because it takes a long time to get all the employers to fill it out. But there's precedent here where they've skipped data releases and then they just kind of catch up over time. But that is one of the big questions, and you've got a whole bunch of other data as well, CPI and other crucial data sets that are going to be skipped because no one's doing the work right now.
Big question mark about the quality of that data once it is collected and
released. That's pre-existing, right? We don't know. I think the faith in that data was starting to decline anyway.
Well, yeah, but people who do have data, they looked at ADP yesterday, and you could get 6 different explanations of what we exactly saw. So it really comes down to A, how good is the data collection, and B, do we understand anything about the data, even if we were to get it in some sort of integral level?
We're not going to settle that debate at the Federal Reserve anytime soon. John, it's good to see you.
Great.
Let's do it again soon.
Yeah, happy to.
The train works. John Lieber,
it's
if you're
expensive now.
I know.
It's because the planes are actually cheaper than the train now.
Everyone's sort of, I get it. I started using the train too.
They do.
It works.
Yeah, it's better than this.
It's much better. There's no security. You get it on
Though.
downtown.
Food is a little
bring your own food.
Oh, yeah, totally.
Great food hall in Moynihan.
Exactly.
Food there.
Guys, just saying.
Room service, room service, train service.
Looking to add some weight to yesterday's rally. Equity futures this morning slightly positive on the S&P 500 up by 0.1%, on the Nasdaq 100 up by 0.1. As we count you down to the opening bell about 2 hours away with your morning movers, here's Yahira. Hey, Yahira.
Hi, John. We start with Moderna. Those shares are rising in the pre-market after the company posted a smaller than expected loss, giving some relief after a tough year due to falling demand for its COVID vaccines. The stock had dropped more than 40% this year heading into the earnings, so the bar was low as investors continue waiting on Moderna to find a new growth moat beyond COVID. Meanwhile, moving on to ELF shares, they are also falling down more than 21% now in the pre-market. That is despite the company saying it had a record-breaking Sephora launch of Hailey Bieber's beauty brand which Elf recently bought, but that failed to distract investors from a lower than expected quarterly earnings plus a weaker outlook for this fiscal year. And we end on Marvell Technologies. Those shares are rising more than 7% in the pre-market. And that is after Honor reporting that SoftBank considered a takeover earlier this year in what would have been the chip industry's biggest deal ever, since the plan would have combined Marvell with ARM Technologies, which SoftBank already controls. John?
Yahara, thank you. Appreciate the update. More from Yahara in just a moment. On our radar this morning, our top story, the Supreme Court appearing skeptical of President Donald Trump's tariffs. The justices questioning the use of IEEPA, with Chief Justice John Roberts suggesting the move imposes taxes on Americans. Elsewhere, Apple planning to use a Google-developed AI model to help power its Siri overhaul. The two companies finalizing an agreement that would see Apple pay roughly $1 billion a year for access to Google's technology. And finally, JP Morgan boss Jamie Dimon saying the headcount at the bank will likely remain steady or rise as the company continues its AI rollout. The announcement coming after a wave of job cuts at other employers.
Two things. Number one, a number of bank executives have said not necessarily that AI and the deployment of it will lead to layoffs, but just the business expanding while the headcount stays the same. We heard this from Brian Moynihan as well. Not sure whether that's the best arbiter of just what AI is going to do in terms of the job market in the rest of the universe. The second thing is, if that is the case, that right now AI deployment will not replace jobs, are all of the layoff announcements that we saw this morning from Challenger Gray Christmas, are all of the discussions of AI at corporate headquarters, there's a reason not to hire, an excuse that really just speaks to a very difficult moment where they want to bring in the belt? So these are some of the things that I think come out of some of those comments.
The framing of this, of course, is PR spin. Really, this replaces potential jobs. That could be one other way of looking at things right now, because the message that I'm hearing from Bank of America, from JP Morgan so far this week, has been a very powerful message for investors. We will generate each additional dollar of revenue and it will become less and less labour intensive. That's fantastic news for investors. And that speaks to the moment we're in. There seems to be a decoupling, if we can call it that. Maybe that's a stretch, but certainly a little bit of tension between what you're seeing on headline growth, which is OK, and what you're seeing on employment, which is a step down, a massive step down in employment growth. And we've gone back and forth on this all year. For how much longer can that persist?
Especially given the fact that the lower, younger cohorts are having trouble getting new jobs. To your point about the idea that entry-level jobs are probably more challenged because it does prevent future hiring. There is also, though, a larger question here, which is they might be adding headcount at a place like JP Morgan, but in what areas? It's not the same areas that they were in the past. They're different kinds of jobs. And so it raises a question. It might, in the future, create more jobs than it destroys. But what are the retraining programs? How do these companies really make sure that a lot of the employees, have the skills that they need to actually adapt to the new technologies?
These are problems for politicians like right now,
Correct.
Yesterday,
Correct.
Last week, months ago, last year. They're already late, I think, on this issue.
But this is my issue. How much are we missing the boat? Is this the next globalization issue? Not necessarily are you going to stop this train, but how do you adapt to it and make sure that people don't get lost behind? And that, I think, is something that we're seeing in a lot of the data and, frankly, in the commentary that we saw out of Challenger Gray and Christmas when they said the planned layoffs came from technology and warehouse sectors in particular, and it came on the heels of both AI as a convenient way of avoiding a downturn that we are seeing in a lot of the consumers.
Remember the conversations we'd have with G2 over at Cisco?
Yes.
And we basically asked the question repeatedly, would AI do to services what globalization did to manufacturing? And his response over and over again is, sure, yeah, but more profound, much more profound than you think.
And much faster. And this is the difficulty. It's happening in real time. And so how do you get people up to speed, given the fact that things are changing under their feet? And I think that that's really going to be an increasing issue.
Let's stick with the labour market. Lisa mentioned the Challenger October job cuts surging to a more than 20-year high for the month of October. Bloomberg's Mike McKee has some more details on the figures. Good morning, Mike.
Good morning, John. And what you and Lisa were just talking about is the major reason that Challenger says it is reporting the highest number of October job cuts since 2003. Here are the numbers. 153,000 job cuts announced in October. We're up 65% year to date from 2024. Maybe even more interesting, look at the last two numbers there. We're down 35% in terms of hiring plans this year. And the 2025 seasonal hiring plans announced 372,000 some odd. That's the lowest, Challenger says, since they began tracking this data in 2012. So it is a picture of a labor market that is struggling. And as I mentioned, they blame DOGE for cutting government jobs, and then AI and the softening economy for what companies are saying they're going to do. And that's the key here. This is what companies are saying they're going to do. It's not necessarily what they're going to do, which is why Challenger usually doesn't get as much attention as it's getting this morning. These are compiled from announcements rather than actual job cuts. They may not be carried through. Some may come from attrition. And the cuts are worldwide, not just in the United States. So while this is a bad number, while it looks bad, we don't really have a solid figure to go with it. This is more in the touchy-feely space, the vibe space, than it is in the hard data space.
And the vibes aren't good. But, Mike, let's talk about the hard data. How does it fit in? How does it jive with what else we've heard through the week?
Well, we've gotten bad news on the ISM numbers, both manufacturing and services contracting during the month. ADP came in with a positive number, 42,000, after being down 29,000 the month before. But that doesn't necessarily mean that we're going to be getting a kind of big job gain, because ADP doesn't always match up very well with the non-farm payrolls that we're not getting tomorrow. And also, 42,000 is not very many jobs. So the labor market clearly stalling out. The question is Challenger pointing us to where we're going with unemployment? Because employment itself has really plateaued.
Mike McKee, thank you, sir. With the latest job figures, let's turn to the Federal Reserve. Recent dissents highlighting the lack of consensus at that institution as the central bank struggles with a data drought. The former Kansas City Fed President Esther George joins us now for more. Esther, we were just tracking that story with Mike McKee. I'm sure you were following along. Do you think this Federal Reserve is attempting to address a structural problem with interest rates?
Yes, I do, Jonathan. And I think that's what makes this so challenging for the committee. You can't ignore the story you just heard, which is there's something going on in the labor market. Things are moving in a way, and yet you can't really put your finger on, is this change happening in real time? Is this going to settle out to a more stable view of what's going on with that labor market? Particularly when you are looking at what I would characterize as easy financial conditions and many of the other traditional signs that would go along with this labor market data would lead you to think something different. So it is a challenging time, and those cross currents of information and data are making it a tough job for the FOMC.
And it's an even tougher job for investors to understand how the FOMC is going to respond to that data, because the reaction function doesn't seem clear. You have a lot of dissent. You've got a lot of fissures on the committee, but you also have, frankly, a question of how much they're looking at the unemployment rate versus the actual total number of jobs and how much that's taking priority over inflation. Do you have a greater sense of what that reaction function is?
Well, I do not, Lisa. And I think you see that in the discussion at the committee level, which is to say, where are we putting our weight? In September, the committee came out very clearly and said, we're putting our weight on the labor market. When we see this softening, we're inclined to bring our policy rate back to something that we are guessing is more normal than where it currently sits. And that narrative is held through to two meetings. And this meeting, of course, we got the question mark, I think, of whether that narrative would continue. So the information coming in and the fact that you don't have official data to back up some of those views is going to make this, I think, difficult for individual members to really reconcile their views and come to terms with that.
Is this a Fed that has a dual mandate still, or does it have more mandates than that? And I wonder if it's also keeping interest rates within a reasonable level, especially with the deficit where it is. If that's an increasing factor, even if not verbalized, in the back of people's heads.
Well, it is the idea that the Fed needs to keep rates low to assist the federal government's debt position is certainly not one of its mandates, notwithstanding the pressure that you see coming from various corners to try to accommodate that. It is going to become, I think, an increasingly difficult issue that will intersect with monetary policy, because we know that these higher debt levels, without some plan in place to bring those deficit spendings down, are going to put pressure on the Fed. It will put higher interest rates in front of them. Inflation issues will begin to become more dominant, I think. And so that intersection is a very difficult one for a monetary policy group that is assigned to judge labor markets and price stability in their mandate.
Esther, where do you think we'll be on December 10th? I've got no idea how much data we'll have. Do you think we can settle any of these debates by the time we get to the middle of next month?
Well, it doesn't seem likely. And Jonathan, what you hope is whenever you're in a period of uncertainty and trying to weigh the risk, that you don't get an unexpected shock to the economy. And again, I don't see anything out there that says we resolve this uncertainty. But I think that's why it makes it a difficult time for this committee to reconcile views, is because that uncertainty looks like it is going to persist for some time.
So, Esther, is that another way of saying that rates might remain on hold for some time, at least until, say, spring of next year?
Well, they could, and you're going to have people argue for that, for sure. But I also think the committee will have to wrestle with the narrative of the labor market signs of weakening. And that was the beginning of their rate cut. So the chairman's put the markets on notice, not to presume that that cut is coming. On the other hand, if the data, however informal, however pieced together it might be, does not change that narrative, they could be inclined to continue that cutting cycle.
Esther, if the Supreme Court overturns the president's use of IEEPA for tariffs, and you don't have that revenue coming in, and that isn't necessarily any kind of discussion on the inflationary pressure if that money gets refunded, do you think that gives the incentive to the Federal Reserve, to the FOMC, to cut rates more aggressively?
Well, not necessarily, Lisa. And the reason I think that is because I think this throws another log of uncertainty onto the fire. If the federal government has to do something different with those tariffs, that then raises the prospect of where do we find that happening? Will it be sectorial? Is it going to be in terms of lowering revenues immediately or in the long term? It is another, I think, reminder of why it is so important for policymakers, not at the Fed, but policymakers that are thinking about our fiscal situation, to really begin to be more forward-looking about what we face as a way to lay a foundation for future economic growth. Because right now, we're in a bit of a soup that isn't providing the kind of foundation that I think we need.
Esther, powerful final point. Appreciate an update from you, as always, the former Kansas City Fed president. Esther George there on the Federal Reserve. We've been waiting for the impact of something that happened 7 months ago to take form, to materialise, and here we are talking about a change in policy all over again. Talk about that soup. That soup is getting even more difficult to wade through.
We haven't even had the full tariffs put on, and a lot of companies have been delaying it. Well, suddenly we could have it totally overturned. It is very difficult to come up with any kind of concrete policy or guidance in this type of environment.
Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The Supreme Court cast fresh uncertainty over President Trump's tariffs, suggesting he may have overstepped his authority. In a nearly 3-hour hearing, the court hinted it was ready to put significant limits on Trump's signature policy. Chief Justice John Roberts called the tariffs an imposition of taxes on Americans. Meanwhile, the Trump administration announcing it will cut 10% of air traffic at 40 of the nation's major airports. The plan is meant to help air traffic controllers amid the government shutdown and could force thousands of flights to be canceled nationwide. The cuts will take effect starting tomorrow. And New York City Mayor-elect Zohran Mamdani has tapped former Federal Trade Commission Chief Lina Khan as one of the co-chairs of his transition team. As FTC head under President Biden, Khan became known for her tough approach to antitrust cases, particularly against tech companies. According to a spokesperson, she will advise Mamdani on economic policy and personnel. That's your Bloomberg Brief. John?
Yahara, thank you. That's the welcome mat for Global Business. Lina Khan.
It's so funny. It's like the point and counterpoint. This is someone who business really doesn't have fond feelings for, but a lot of people say she's only going to stay for a short period of time. She's not going to actually shape anything. You know, pick your poison.
Look, I said this a few times. I wish them the best of luck. I think we all hope they have the great success. And by success, I mean, I hope this city does tremendously well, makes lots of money, and everyone gets a whole lot wealthier. I wish them the best.
I think a lot of companies do too, and that's the reason why they're willing to work with whoever comes in, hoping that it actually works.
And let's see if they take their advice. Up next on the program, a global bond rush.
We're seeing a much larger theme of a strong economy. You will see challenges in certain companies late in a cycle, but we are not seeing any kind of credit cycle on the horizon that's waning anytime soon.
Up next, we'll catch up with Brad Rogoff of Barclays on the latest in the bond market from New York City. You're watching Bloomberg TV. Live from New York City, welcome to the program. Equity futures on the S&P 500 with a lift here on the S&P up by 0.15%. In the bond market, yields up yesterday, down this morning just a little bit. We're down by 2 basis points across the curve on 2s and 10s. The 10-year bond yield this morning around 4.13. Under surveillance this morning, a global bond rush.
We're seeing a much larger theme of a strong economy. We're seeing an administration that's very pro-business, not very regulatory friendly, want to push rates lower. And so all of those things where you will see challenges in certain companies late in a cycle, but we are not seeing any kind of credit cycle on the horizon that's waning anytime soon.
So here's the latest this morning. Global bond sales soaring to a record high this year as Wall Street braces for the busiest November in a decade. Joining us now, Brad Rogoff of Barclays. Brad, good morning, sir.
Good morning.
We've seen a lot of issuance. Thanks for being here. Let's talk about where it's coming from.
Yeah.
Where is that supply coming from at the moment?
Yeah, so in the past week, tech has been the number one, and the funding of this AI revolution. You guys were talking about AI a little bit earlier, and so we've seen huge deals. You've really seen net supply, actually, if you look at the investment grade market, right, the biggest corporate bond issuance market, actually net supply wasn't that big until the fall. And so September, October, getting into November, it is starting to pick up substantially here. Demand's been fine. You've seen, flows into corporate bond funds throughout the year. So there's demand. But look, the market has been a little bit softer here. Nothing material, but a little bit softer. I think it is because of supply.
You think it's because of supply?
I do.
Not the broader risk environment at all?
No, I think, look what's going on in equity markets, right? A little bit here and there, whatever. But like when you think about where equity multiples are today, any even small moves in that, it shouldn't really matter for investment grade corporates. I do think it's a little bit of indigestion to the point where, hey, if supply slowed down here, you probably see some tightening in IG credit spreads.
You keep talking about IG,
yeah,
but it is more broad in terms of the issuance. And I'm just wondering, is this a K-shaped corporate debt market? I feel horrible about saying that, I'm sorry, as well as it is a K-shaped economy and a K-shaped market in the equity space.
Yeah, well, so look, I was talking about that because that's where the supply has been so robust recently. But yeah, you have to look at different fundamentals across different things. And obviously, credit markets have been in the news quite a bit recently with some stuff on the downside, I think, to your K point.
Some pests, yes.
Yeah, some pests. So how many exterminators do we need? So look, if we look at the high yield market broadly, which is I think where you would then say, okay, what are we finding there? The broader trends in high yield aren't going to tell you the credit cycle is about to turn, right? The distress ratio is not particularly high. There are a few industries that are maybe under a bit of pressure. They're not the industries with the biggest amount of debt outstanding. So yeah, there's maybe something a little bit different going on that's led to some of these issues, these cockroaches, and we can talk about that, but it's not across the whole high yield market.
I just heard a collective scream from people. Let's not talk about cockroaches. It's still pretty early in the morning and we're having breakfast. But I do think this is an interesting question. And John raised this earlier, and it was a really astute point, that usually the biggest risk is in the area of the markets that are perceived as safest. Mm-hmm. And we're talking about the potential for problems in lower rated credits where people are scouring the playing field for some sort of issue. Is the problem developing in the tech issuance with concentration risk and a larger portion of the corporate debt market hinged to a cyclical industry that has not faced a real test yet?
So another kind of old axiom is also usually the sector that has the greatest issuance or the greatest increase in size in credit markets over a period of time is also where you often find issues. So if you think back to 2015-16, you think back to energy, we had seen that become a much larger portion of corporate markets, especially high yield to high grade to some extent. There were issues there, right? And you can think back to financials, and there's many times where we can think back to this. So I think you're right to look there. But the one thing I would say to people is if we're thinking about the investment grade issuance that we're seeing right now, we are looking at companies that, while they're often the highest beta portion of the equity market for obvious market cap reasons, these are the lowest levered companies within investment grade, right? And so we're not going to be there yet on that. If I just flip really quickly, though, to high yield, maybe not even, but if you go to loans and then really go to private credit, the tech portion of that is by far the largest, right? And that's where, once again, not seeing the issues today, but look, when it's gotten that big, it's something we've got to pay attention to.
What are we exposing ourselves to in the tech space? And I've been thinking about that increasingly because people draw some parallels to, say, the shale patch or the railroads of 100 years ago or cable being laid down in the late 90s. But this feels different because of the tech that they're investing in and how rapidly some of that depreciates. What should the approach be to this compared to what the approach was to other big CapEx cycles?
Yeah, so there's positives from that CapEx side, right, in the sense of if you look at who is doing a lot of the CapEx, these big hyperscalers, and we've done a lot of work on trying to say, okay, go back to the year 2000, 1999, and you look at who was doing that, could they afford it, so to speak? Sure. You look at their free cash flow, their leverage, even the CapEx to sales ratio then was, you're talking about 40% versus 25% today. So the companies that can afford it are actually doing that, right? So that's certainly a positive. The flip side is if you look at a lot of the other tech companies out there, not the biggest ones, there's a lot of software companies, right, in some of these leveraged loan and private credit markets. And, there you get into a question of if such rapid changes, what does that mean for the business models? Some of them are going to be fine. Some of them are going to, have issues for obvious reasons. And look, to me, that's a normal credit cycle. It doesn't get me too worried, but it over time will lead to a bit more stress than we have today.
Gives you pause, makes you wonder if you should own 50-year tech debt, which is something we keep going back to.
Yeah, it makes you wonder how many ways you can short this going forward, which is, I think, something that people like Michael Burry and potentially even Deutsche Bank was looking at potentially hedging some of their exposure to data center loans. I just wonder how much that activity is picking up.
Your key word, developing.
Yes.
I think that is the key word at the moment because all of these guys across the whole of corporate America strengthen their balance sheets to such a degree coming out of the pandemic that we've had people come on for years on this program and just say, look how strong balance sheets are, look how strong balance sheets are. It feels like this is only just getting started. I think maybe developing is the key word.
A lot of people are not saying this is a cycle that's going to end that soon. The longer it goes on, though, the more people are feeling, I better look for ways to hedge.
People are making money moving a lot of paper over the last week. Let's put it that way. Brad, I'm not naming names. Brad Rogoff of Barclays. It's good to see you, sir. Coming up, Mark Lehman of Citizens Commercial Bank, Kathy Wood of ARK Invest, Neela Richardson of ADP, and Nisha Patel of Parametric from New York City. The third hour of Bloomberg Surveillance. Up next.
We should not be surprised that we are seeing volatility. You still do have a sort of K-shaped market.
In the near term, caution is warranted.
It's early to abandon any bullish call.
We own what we own. If the market goes down and these stocks go down, we're going to buy more.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P positive by close to 0.2%. Similar move on the Nasdaq and on the Russell too. In the bond market yesterday, yields up across the curve, down just a touch this morning. 2s out to 30s. We're down by 2 basis points on a 10-year, 4.13. Lots to talk about in the last 24 hours. The economic data, conflicting economic data, and a Supreme Court hearing in the future of the president's tariffs.
If you want to be optimistic about the economy, you take a look at the fact that services activity does seem to be picking up according to ISM data out yesterday. You also can point to the ADP report that did have an upside surprise. Then there are questions about the deficit. That is the bad way of interpreting the sell-off in the bond market, which is essentially if the Supreme Court does overturn the latest iteration of tariffs from President Trump, how much does this remove from the U.S.'s coffers that ends up leading to be some sort of bond market risk?
If you want to get depressed, just read some of the lines we're getting, the transcripts we're getting from the restaurant chains in America at the moment. Carver, challenging. Chipotle, consumer slowdown. Even McDonald's, cautious. this has been a theme that's been building now for quite a while.
And they all point to the fact that lower income consumers have really been struggling. I was struck by the fact that McDonald's came out yesterday and said that they saw double-digit declines in lower income consumers. You pointed this out, and then double-digit gains among some of the higher income cohort. It raises a question, how are these companies managing it? And does this speak to ongoing weakness? They also flag this isn't probably going to end heading into next year.
We don't get much data right now, but we get a read on the consumer through the earnings. In about 2 weeks' time, you'll hear from Target and you'll hear from Walmart. I think those two earnings report coming into sharper focus after what we heard from the restaurant business.
Yeah, and if we do see some sort of similar reflection of that, what does the Fed do with that? We keep coming back to this. How do they deal with a bifurcated consumer? The idea that we could see acceleration in some parts of the economy at the same time that we don't see jobs getting created in tandem. At the same time that with the ISM services data, we saw inflationary pressures, and we see that with a lot of the consumer products goods as well. Walmart has talked about the fact that they are going to try to absorb as much as they can in terms of price increases, but they can't do that forever. So a lot of questions. It is a soup mixed with a mystery, mixed and wrapped in an enigma.
Something like that. Not a tasty one.
Yeah.
Anyway, fair to say we've got gridlock on the committee at the Federal Reserve, and it's unlikely we address that gridlock anytime soon.
I think it's gridlock within people. I mean, I think that Bob Dole nailed it when he said, I personally feel like I'm 5'4", because there's sort of these conflicting crosswinds, and it's not clear that there is a clear reaction function coming from the Fed. It is fair to say they're in a back seat right now rather than out front, leading in any kind of economic cycle.
The grind higher resumes in the equity market. Equity futures positive by 0.2%. Coming up this hour, we'll catch up with Mark Lehman of Citizens Commercial Bank as stocks are edging higher. Kathy Wood joins us of ARK Invest as Tesla shareholders cast votes with Elon Musk's future on the line, and Nita Richardson of ADP with the government shutdown heightening economic uncertainty. We begin this hour with stocks steadying and tech concerns easing. Mark Lehman of Citizens Commercial Bank writing, AI remains a powerful economic driver. The fundamentals are strong and the pause was more recalibration than concern. Mark joins us now for more. Mark, good morning. Good to see you.
Thanks, Jonathan.
Over from the West Coast, I'll give you the vibes on the East Coast on Wall Street. I've had people come on the programme and say a bubble in bubble talk. What's it like on the West Coast? How do you talk about the same theme?
I mean, we've talked a lot about bubbles, but I always think about when you drive from SFO into the city, as many of us have done, just look at the billboards, and every single billboard is AI. So it does tell you a lot about what's going on in the economy. But I'll be a contrarian. If you got a room full of people and asked Wall Street investors and pundits if there's a bubble, every single one of them would raise their hand, which leads me to believe it's a little early. And the bubble talk is very plausible, but when everybody says the same thing, I kind of run the other way.
Would you call it a boom?
I would call it a boom. I've said it on this show. I said this is the second coming. It is. It's early. We're going to have some fits and starts. We talked the same way about the pipes and plumbing that we built in the late 90s for the internet. The bubble talk was right, but it wouldn't have gotten us Netflix and all the other companies we talk about on the show every day.
As Vice Chair of Citizens, how much are you willing to put at risk in a story that could become a bubble, but at the same time it feels like there's something real?
It's a great point. We talked about it yesterday with our colleagues. We have a very large data center exposure here at Citizens, and we're doing a lot of investing in those companies, both as for principal as well as internally. We're very cautious on everything we lend to, but we're also part of the innovation economy, and we want to be known for that. And increasingly, that's becoming more of it. I've said forever that technology is a horizontal, it's not a vertical here, and we think that way. And data centers and AI and all that is wrapped up in it. And I do think it is early, but we look at everything specific to case by case and company by company.
How important is it to avoid a certain degree of concentration risk, to offset that in some capacity, even if you are part of the innovation economy and do believe that there is an opportunity?
It's the right question. Concentration risk is a big thing. We could have talked about that about office 10 years ago, and no one saw the pandemic coming. And a lot of people are assessing that right now with what you're seeing in AI and what you're seeing in data centers. I do think that there is an enormous there's waves through that, right? You look at the utility market and what has to power these data centers and all the things that help power this. But I do think this is a revolution. This absolutely is a revolution. Coming with the revolution is a lot of copycats and a lot of Me Too's, and those are the ones we want to avoid.
Mark, these companies are changing. Can we talk about the leadership and the management of these companies? Yeah. Did they have experience managing real estate? Did they have experience becoming energy companies? These are not the same companies we invested in as the winners of .com. They are very, very different and will be different in years to come. Do you have confidence in the management teams to manage that effectively?
Jonathan, it is absolutely the right question. I think there's a lot of company-specific research that you have to do here, and you have to look at it as an investor as well as what we do as a bank. Like you said, we could have said that 25 years ago a lot about those companies, and some of those became the biggest unicorns we've ever seen. So I think it's the same. But again, these are spaces we've never seen before. This is the type of computing, this is the type of innovation that we've frankly not seen before. So again, I'll go back to it's got to be company specific. And just because you haven't sat in that chair before, frankly, if you've been in a chair that looked like that, but at a company that was akin to that, I'm not sure you'd want to be there either, and I'm not sure I'd want you there either. I think the people who have, Elon Musk got to the chair he got to because he had not sat in that chair before, because you watched as GM, Ford, and Chrysler didn't do anything for a very, very long time. These are companies doing things that, frankly, the incumbents that we could talk about didn't do anything about it. Look at Intel, right? They've sat there for 25 years while NVIDIA created itself. I think you're seeing the same thing right now, and you're going to see incredible capital formation, and we want to be part of that.
Who are the incumbents right now that you'd worry about?
Yeah, I think you look at how Microsoft has evolved. They've done an amazing job. Facebook is obviously doing something. Meta's doing something that is transformative to the company. They've transformed themselves. I mean, we don't even talk about the metaverse anymore, but it's still their ticker. So you're watching these incumbents work really hard to become part of that. It's an arms race, and you're seeing the kind of capital that has been raised, even in the bond market in the last 2 weeks. It's stunning. But again, we'll talk about bubbles, but I just don't see it right now. I think we're creating something that's going to be vast and transformative, but when everybody thinks it's a bubble already, I just don't get it.
How important is size right now? And I say this at a time when everyone seems to be wanting to tie up with one another and get bigger and bigger and bigger. How important is it to be big to win?
I think right now size matters. I think you're seeing more and more of these partnerships because, frankly, I think some of the buyers don't even know, right? They're mostly buying talent. And they're trying to pair up, and you see these. I've seen these wonderful interlocking charts that are going around about how Meta and NVIDIA and Facebook, and Amazon and Microsoft are all competing. We haven't even mentioned OpenAI. I think they're important because there's so much data and there's so many things that are going to transform. A lot of people think about it as ChatGPT or OpenAI. It's so much more vast than that, and I think there's some optionality that we're creating.
How much do you think that it's important for you and your firm to also be part of that trend?
Yeah, I mean, I've lived in San Francisco for over 30 years. We've been on this show talking about how things are going awry in San Francisco. Everybody's now on these shows talking about how things are coming back. Citizens has a huge presence in San Francisco. We built out a private bank all over the country, but San Francisco is a big hub for it. So we want to be known for that. We do a lot with the innovation economy, with our small business lending, and some things where companies really start. And we want to be known as a company that meets these early companies and gets to know them and really helps them, both the individuals and the professionals that work there.
Mark, can we just finish on some detail? The kind of companies you are focused on, that you're sort of super optimistic on right now that maybe don't get talked about enough, what are they?
Yeah, I mean, I think there's a lot going on in financial services and payments that's really changing the way we do things. We talk about crypto all the time, but payments is a huge opportunity for us. There's actually revolutions going on in insurance because we need to innovate as it relates to that. And there's also financial services companies that I think are changing the way we bank, and we want to be part of that. So as much as people can look at the screen and look at what's going on and be a little bit worried about valuations, this is the golden age of innovation right now. AI is powering that, but this is the golden age of innovation in life sciences, and we're a part of that, which makes me feel real good.
It's very easy to be snarky and skeptical about it. I often think back to a 60 Minutes interview that was done 25 plus years ago, and the journalist was sitting there laughing about how big Amazon was and couldn't believe that this book company was this large and had a market cap that big. But he could also understand the potential that the book company wouldn't be a book company in 25 years and that it would be something else.
You can't underestimate the innovation. I remember mea culpa, Netflix, when they were borrowing so much money and they were junk rated, and there was a question, and I was thinking, I remember when we got DVDs in the mail, and that really is going to come into some great company, and is that really going to be a real player later on? And here we are. It's all my kids talk
and you're exactly right. Netflix would not be here if we did not overbuild the pipes in the late 90s. They would not be here today.
Mark,
so
it's
think
good
about
to see you.
Thanks,
Thank
John.
you, buddy. Thank you. Mark Lehman there of Citizens Commercial Bank. Let's get you an update on news worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. The Trump administration saying it can provide recipients of low-income food assistance known as SNAP with more of their usual benefits this month. Officials at the Department of Agriculture found an error in their earlier calculations and worked to issue new guidance. The administration is now instructing states to provide recipients with 65% of their usual benefits. Meanwhile, shares of Marvel are rising 8% after SoftBank reportedly explored a potential takeover of the U.S. chip maker earlier this year. Sources telling us here at Bloomberg that SoftBank toyed with the idea of combining Marvel and ARM Holdings. And while there aren't currently any active negotiations on a deal, it's possible the interest could be revived. And ESPN has signed a multi-year deal with gambling giant DraftKings to make it its official betting partner. The move ends a 10-year agreement between ESPN owner Disney and Penn Entertainment. Bettors will be able to access DraftKings Sportsbook, daily fantasy contests, and other products through the ESPN sites starting December 1st. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. Thank you very much. Up next, the Morning Calls Plus. We'll catch up with Kathy Wood of ARK Invest as Tesla shareholders cast votes with Elon Musk's future on the line. That's up next. This is Bloomberg.
There is no other person that is Elon. We think that he is the right leader for the company over this next decade and delivering the plan and the opportunities ahead of us. So it's about how do we create the most value for the company and for our shareholders over this next period of time. And he is the right leader for us over this next decade.
That was the Tesla board chair, Robin Denholm, on the vote that's taking place a little bit later. We'll have more on that story in just a moment. Equity futures on the S&P positive by 0.2%, on the Nasdaq 100 higher by 0.18%, on the Russell up by 0.25. In the bond market, if we can turn to fixed income briefly, bond yields shaping up as follows. Yields down across the curve, down 3 on 2s, likewise on 10s. Your 10-year 4.13. That's the price action. Let's get you some morning calls. First up, JP Morgan raising its price target on ARM Holdings to 180, forecasting more AI momentum and higher value capture. Your second call from Argus upgrading Supermicro to a buy, saying its strong forward momentum is being overlooked. And finally, Bernstein raising its price target on Qualcomm to 215, citing its fourth quarter outperformance. That stock is still trading lower. Another one in the last week. This market's pushing back. We're down by 1.3%. Sticking with tech, Tesla CEO Elon Musk facing off against shareholders over his $1 trillion pay package today. Bloomberg's Craig Trudell joins us now for more. Craig, welcome to the program, sir. What's at stake a little bit later?
Yeah, I think all eyes are absolutely on the vote over Musk's compensation for obvious reasons. We've seen a couple of times now that when shareholders have been asked whether to award a significant amount of stock to him, they've approved it by pretty wide margins. So first in 2018 and then last year, both of those votes came in with more than 70% approving. So I think in addition to the question of, will it get approved or not, it's going to be interesting to see, just as a sort of barometer on Musk, where that vote comes in. And I think the other, major proposal that everybody's going to be watching very closely is a shareholder proposal on whether or not Tesla should invest in XAI. It's not a sure thing that Tesla will then sort of take that vote result and decide to proceed with a vote in Musk's artificial intelligence startup, but that definitely is I think, a focal point for investors, regardless of where you come out in terms of for or against it.
Well, Craig, do you think that people have just been distracted by the number itself? Should the number matter so long as the incentives are well aligned?
Yeah, I think it's an interesting question. I think, $1 trillion definitely sort of pops, and yet, the sort of challenges that Musk will have to overcome to reach that are pretty remarkable. And we could have said that about the package that was laid out for him in 2018, that to his credit he achieved. But we're talking about sort of inventing businesses that don't exist for Tesla just yet. Robotics, for example, Musk has been talking an awful lot about humanoids, but the Optimus robot that he's showed off is still very much at a prototype stage. And so, we would have to see Tesla really just absolutely, outperform in the years to come to reach the market cap levels that they need to, but also, on the operations side, sort of go above and beyond even what was achieved to hit all of the numbers that were laid out for him in 2018.
Craig Trudell with the latest in London. Thank you, sir. To build on this, the ARK Invest CEO, Cathie Wood, one of Tesla's biggest bulls, the EV maker, the top holding in her flagship ARK Innovation ETF, has this to say: I do not understand why investors are voting against Elon's pay package when they and their clients would benefit enormously if he and his incredible team meet such high goals. Cathie joins us now for more. Cathie, thanks for making some time for us this morning. Good morning to you all. Do you think, Cathie, the incentives are well aligned?
Yes, we do. I do not believe any company anywhere near this size has ever delivered a compound annual rate of growth for EBITDA, which is a bottom line number, of 41% over 10 years. No company has done that. So, yes, indeed, the incentives are aligned. If he and his team are able to deliver on that number, the stock is going to outperform enormously.
Cathie, if by chance this proposal is rejected, would you consider shedding some of your Tesla position?
So I'm happy that the prediction markets are at 90 to 95% in terms of this is going through. So we don't have to think about that. Clearly, if Elon left, we think about it in two ways. One, we think robo-taxis, he has them at the starting gate as of June, and now they're rolling out. And that AI project is well underway. If he had left 5 years ago, 3 years ago, it probably wouldn't be anywhere near where it is. What we now think, though, is in order to capitalize on humanoid robots, which that's a much more difficult project, that, yes, Elon's brilliance and the team he has attracted around him are going to be necessary to pull that off. Our price target, $2,600 in 2030, is 90% of that valuation is robotaxi. We have very little for humanoid robots. If humanoid robots evolve as quickly as Elon thinks, now remember that's Elon time, but he already has a running start because robotaxis are robots. They're electric, they're powered by AI. Those are the three innovation platforms that will power humanoid robots as well. So he's ahead of the game on that one as well. But I do believe he's the right leader to bring that part of the story to life as well.
Cathie, I've got to ask you this, though, to follow up on Lisa's question. If you wouldn't sell, if he wasn't CEO, then why should we pay him that much to be the CEO?
What I'm saying is we would feel comfortable with the robotaxi part of the model, but we would not be able to build with confidence the humanoid robot part of the model. So over time, of course, as the story would depend more and more on that leg of the story, we would be taking our position down.
You talked earlier, Cathie, the past couple of days about this reality check that's going on in the tech sector. And I understand that Tesla is sort of in its own place and that you do hold them for the long term. How do you understand the reality check that's currently going on within a lot of the biggest tech stocks and this sense of skepticism about whether they can keep growing at that rate versus the long-term bullish bet?
You know, I'm really happy that there is so much skepticism out there. Anyone who went through the late 90s will remember there was no skepticism. And we had valuations based on the number of eyeballs on a website maybe 10 years from then. We're not seeing that right now. We are seeing, wait a minute, they're spending a lot of money on these data centers. This is a little bit of a different story than I was investing in, certainly in terms of, when I say the average investor was investing in with the Mag 6. Those were just cash cows, and and had huge cash positions. Something's changing here. It's making the typical investor a little more, I'll say, skeptical. This is not just the cash register ringing anymore. This is, a big bet on the future. So I'm happy there's skepticism. I think it's a good thing.
Are you buying right now? Are you seeing the skepticism as a chance to build some of your portfolio?
Oh, sure. And probably the most undervalued part of our portfolios is in life sciences, healthcare, because we think that is going to present the most profound application of AI out there. And yet it is highly underappreciated because, healthcare analysts aren't comfortable with tech and tech analysts aren't comfortable with healthcare. And, we've got a very siloed ecosystem in terms of the way research is done. At ARC, we're very focused on the technologies first and how they're going to scale across sectors. So our analysts are organized by technology. And we think there's a huge inefficiency there.
Kathy, thanks for being so generous with your time this morning. We appreciate it. Kathy Wood there, the ARK Invest CEO, on Elon Musk of Tesla and a whole lot more. We talked about this with Craig. If the 1 trillion number has become a bit of a distraction, so long as the incentives are well aligned, is the number a problem? I guess that's one debate. Here's another one, though, Lisa. Can a company this big have this much key man risk? And I think that's a very separate one to ask.
Yeah, is it a feature or is it a bug? And ultimately, in the mind of Kathy Wood, she was saying it's a feature. He's brilliant. He can do all these things that he's promising. And if he's aligned to this idea that he's going to create a 7-fold increase in revenues and doubling in the car sales, that's a positive for the overall company. On the flip side, what if there is some sort of big falling out with President Trump? What if there is some sort of personal fissure? What if there is a health problem? I mean, there are so many issues that get built up if someone is really the face and the end-all be-all of a company.
It's hard to get away from that T, isn't it? 1 trillion, it's just huge.
Why does he want it so bad? I mean, it's like he's going to take it so personally. He would leave the company if he doesn't get $1 trillion. He's already, the world's richest man. What is it? What's he going to do with $1 trillion?
It's difficult to internalize a number that large.
Build a colony on Mars?
It's kind of crazy. Maybe, yeah, maybe.
Would you go?
No, I wouldn't. I'm happy on Earth. I'm sort of happy here for now, Bramo.
That's good.
I'm waiting for that. I'm waiting for that alphabet 50-year bottom to mature.
We'll be sitting here. Good morning.
Be right here anchoring this show like every day.
Yeah.
Up next, Nita Richardson of ADP. Session highs in the equity market going into the open in about 60 minutes from now. On the S&P 500, higher by 0.25%. On the Nasdaq 100, higher by a similar amount. Same story on the Russell. Your small caps this morning up by close to a third. In the bond market, 2-year, 10-year and 30-year bond yields down through most of the session, down 3 or 4 basis points now at the front end of the curve. 359.45 on 2s, 412 on 10s. As we count you down to that opening bow, let's get you some single names, some morning movers. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. A leadership shakeup and very weak results are hitting CarMax this morning. Shares are down 10.5%. The used car retailer terminated CEO William Nash after the stock halved this year under his leadership. Meanwhile, they released preliminary third quarter results and they were not good, showing that used car sales fell sharply at their stores, marking the largest decline in 2 years, showing that the company has not been able to capitalize on the strength of the used car market amid tariffs. Meanwhile, also moving to the downside, we have Papa John's. Those shares down 3.8% after comparable sales unexpectedly fell when analysts were expecting a rise. That prompted the pizza chain to cut its outlook in yet another sign that consumers are pulling back and dining out or ordering in is where it's showing up. And we end on a big mover to the upside, and that is Snap. Shares are up nearly 20% heading into the open on a new $400 million partnership with Perplexity AI that will see Perplexity pay Snap to bring its AI search engine to Snapchat. It also came as Snap results showed solid user growth, all of this giving new life to a stock that had been down 30% this year. John.
Huge rally. Yahira, thank you. Appreciate it. Let's turn to the labor market. The U.S. companies announcing the most job cuts for any October in more than 2 decades. The data looking dreadful this morning. Mike McKee has more. Mike, give us some perspective on this data.
Well, that's a way to look at it, John, because this is the time of day, 8:30 on a Thursday, when I'd normally be giving you the jobless claims numbers. And of course, we're not getting that from the Department of Labor, but we have been getting them from the state levels, and they're nowhere near what Challenger is telling us. Challenger says that this October saw the most job cut announcements since 2003. They're also saying seasonal hiring plans are the lowest since 2012 when they started tracking that data. But again, these are announcements. They're not actual cuts. And even people who have lost their jobs, probably getting severance, not eligible for jobless claims yet. So we have to see if this carries through. The Fed continues to be in a fog because they've got this kind of anecdotal data, and they've also got some numbers like the ISMs we got this week and the ADP report. The state jobless claims numbers, as I said, remain low. We'll have those for you tomorrow morning when the state numbers are reported. ADP, 42,000 new jobs in October. Not great, but not falling down below zero. The ISM, as I mentioned, contracting. So where does that leave us? It leaves us with a lot of people wondering what to do on December 10th, and that's the key. We have a lot of Fed speak today. We have Williams, Barr, Hammack, Waller, Paulson, and Musalem all speaking. Some of them will not be talking about the economy. Some of them will. Keep an eye out for any headlines. But at this point, it's that bottom date that really matters. We're still a long way from the Fed meeting, and there's a good chance maybe we get the government open again, we get some data, and we'll see how all of this fits together once we see what the government has been able to count as far as jobs and, of course, inflation.
It's going to take a lot of data to settle that debate at the Federal Reserve. Mike McKee, thank you. Just imagine how it goes. Governor Myron gets those Challenger job cuts and throws them across the table. Then Beth Hammack picks up state jobless claims and throws them back at them. And you just go back and forth with all the conflicting data.
Pretty soon you've got a full-blown food fight over there at the FOMC, making it sound very interesting.
I'm not saying Hammack and Myron fight at the committee meetings. I'm sure it's super, super boring.
Yeah, throwing booklets at each other? Absolutely not. Take a look at this. What about the beige book? Look, honestly, you're looking at a lot of conflicting data. And so how do they reconcile that? Even if you have more data, is it really going to have anything other than that conflicting tone? Because there are many stories being told at the same time from different sectors, different cohorts, and that's what we're seeing in the data that we are getting.
Nina Richardson is not a fighter. She's got this to say over at ADP. Economic uncertainty for consumers and businesses has been heightened by the shutdown. Historically, incertitude has had the effect of delaying hiring, investment and purchase of big-ticket items. Nina joins us now for more. Nina, good morning. Was that an accurate description of an FOMC meeting?
I hope so. I would love the visual itself. I hope they are that passionate about the conflicting data. I know I am.
Are we seeing some stabilization finally on a serious note?
Yeah, I think we are. Going into the numbers that we put out in September, where we saw that big job loss, the question was, when you looked at the GDP in the second quarter, which was strong, was this a trough? I think you might have asked that question, Lisa. And so going out of this last few weeks, we've seen that it looks like it was a short-lived negative impact on the payrolls. And we're seeing a recovery, but it's tepid, it's slow, it's weaker than what we saw in terms of hiring momentum earlier this year. So cautious optimism, a bit of a rebound, but not a full-blown restoration of robust job gains.
So does what you're seeing completely contradict the tone of the Challenger data that we got out this morning?
Well, it's all about timing, right? This is a fast-moving, very complex labor market, and we've seen some big headline announcements. Now, these big companies don't drive all the hiring in the U.S. In fact, big companies are only accounting for a quarter of employment in the U.S. or less. So it's really small firms that we need to pay more attention to because most U.S. workers work for small firms. That being said, announcements eventually trickle into the labor market as cuts, whether through attrition or through outright layoffs. We're not seeing it yet, but it's an early warning signal.
Where is the hiring coming from? We saw the services sector also still in contraction for the employment sector. We saw the same thing for manufacturing. Where is it actually coming from?
Well, we're seeing in trade, transportation, and utilities. That's great. And healthcare. Healthcare is now the new stalwart. It is strong because it is acyclical. It is not affected by interest rates. It's affected by this long moving trend that no policy can change. Father Time. We are getting older, and this aging population is going to require healthcare. And you're seeing that as a job gainer in the data, and I think that will be consistent going forward. Where we're not seeing it, at least we didn't see it at ADP in October, is in leisure and hospitality. And that's what I'm worried about, because this labor market, this economy has been fueled by consumer resilience, and they're not as resilient, at least in the hiring numbers in that sector, as they have been previously. That's a concern.
Nita, when you track the forces in the labour market right now, how influential are the cyclical forces versus the structural forces? Is one greater than the other at the moment?
Let's go back to that data food fight.
Sure.
That's really at the heart of the argument. We don't know how much of these drivers are structural, and they are profound, like aging, like immigration, like AI, and how much of this is cyclical, the uncertainty of hiring, the hiring hesitancy. We're going to be tracking seasonal hiring going into the holidays. Some of that is going to be structural. Some of it is going to be cyclical. And that is the contention here, because there's no easy way to divide those two big drivers.
This goes to Lisa's question. She's asked it repeatedly. If it's the case that it's more structural than cyclical, what difference do interest rate reductions actually make?
Well, that's a profound question. We're in the muddled middle, and that's the issue. If you are looking at a world where inflation is at least going to be episodically higher, because of these labor market trends, we have fewer workers coming in, fewer ways of providing output for an increasingly elderly economy. That is inflationary. Regardless of what happens in the FOMC this year, there are inflationary drivers. So yes, the Fed has to be short-term in its thinking. It has to really adjust to the incoming data when there is incoming data. But these long-term structural effects are going to affect labor markets going forward.
You've really seen a boom in interest recently for ADP data. Everyone's very excited. We have ADP Wednesday now, and it was celebrated.
It was always ADP Wednesday.
Oh yeah,
for me.
there you go. And we were getting estimates, and we'll soon have an ADP whisper number on the street because we have nothing else. And I'm just wondering, if we were getting the other data, based on your experience tracking the labor market, do you think that it would change the muddled middle? Or do you think that we're in the same place where ultimately it just comes down to ideology on the Federal Reserve, what you believe the emphasis should be?
I think the labor data is pretty consistent. It's showing this low hire, no fire kind of equilibrium. I don't think that's good for the U.S. economy. I think this economy is built on dynamism. Dynamism fuels innovation, which fuels productivity, which fuels growth. So I'm worried about that in the long term. But the labor market stats have been kind of lining up pretty well. What's weird to me is the difference between the GDP growth numbers and the labor market. That's the disconnect that I'm seeing, and I'm wondering how sustainable that is.
To put that another way, this is what everyone keeps talking about, that we're seeing a reacceleration in the economy that's jobless, that somehow is not coming along with massive job creation. Some people say this is a positive sign. This points to increasing productivity, can be disinflationary, and going forward can be a huge boom for the United States. You look skeptical. I'm just wondering, what do you think is actually going on?
You know what? I just remember that 2/3 of this economy is consumer spending. It's not in the markets. It's not on Wall Street. It's not in the Magnificent Seven. It's mom and pop stores and mom and pops buying stuff. And the labor market supports 2/3 of this economy. So you can't disconnect the consumer, the real economy, the Main Street macro from the actual overview of the economy. AI is going to be a huge game changer in the workplace, but it's not a huge game changer yet to the people who are just making a living and getting a paycheck and spending those dollars.
Just for the record, it was always ADP Wednesday for me as well, Neela.
Thank you.
I was right there with you.
Thank you, Jonathan.
Right.
Nita Richardson of ADP, thank you. It's going to be weekly ADP soon. That's going to be exciting.
You're going to be a weekly ADP. You're going to do the
Every
drum beat up.
That's no payroll data.
I know, honestly, it is the data. It is the benchmark right now. And a lot of people have looked back and said it actually has been incredibly consistent in terms of what it shows. Just want to say, I'm calling you out. It was not ADP Wednesday for you.
I was always excited.
You did not
about
come in
8:15.
every single day and say, this is ADP
Amy in the control
Wednesday.
room knows how excited I was every single time.
Okay, revisionist
All right.
history.
Nita
Revisionist.
Richardson of ADP. Nita, thank you.
Thank you.
Appreciate it.
Throw a booklet at you.
All about it. Always been all about it.
We're going to be throwing pamphlets of data at each other.
Yeah, they don't fight on the FOMC. They talk a lot, though. Williams, Barr, Hammack, Waller, Goolsbee, Paulson, Musalem, Williams, Jefferson, Myron, just the next 2 days. Enjoy yourself, guys. All right, let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. NVIDIA CEO Jensen Huang says China is going to win the AI race. In an interview with the Financial Times, Huang cited Beijing's lower energy costs and looser regulations. His remarks come after President Trump maintained a ban on NVIDIA selling its most advanced chips to Chinese customers. Meanwhile, Apple is set to be nearing a deal with Google to overhaul its Siri voice assistant. Sources telling us here at Bloomberg the companies are finalizing an agreement that would see Apple pay roughly $1 billion a year for access to Google's technology. The iPhone maker is hoping to rebuild Siri's underlying tech and roll out a slate of new features next year. And Peloton is recalling more than 830,000 of its exercise bikes over safety concerns. The Consumer Product Safety Commission saying the bike seat can break during use, posing a hazard to riders. Consumers are being told to stop using the bikes immediately and contact Peloton for a free repair. Maybe a new bike? That's your Bloomberg brief, John.
Yeah, you think? Yahara, thank you. Just kind of gives you the shivers, that, doesn't it?
I mean, just the visual's no. So let's move on.
I know there's classes, guy. No, absolutely not. Up next, setting you up for the day ahead, plus Nisha Patel of Parametric, as traders look to boost bets on rate cuts from New York City. You're watching Bloomberg TV.
There's something going on in the labor market. Things are moving in a way, and yet you can't really put your finger on, is this change happening in real time? Is this going to settle out? And those cross currents of information and data are making it a tough job for the FOMC. That's why it makes it a difficult time for this committee to reconcile views, is because that uncertainty looks like it is going to persist for some time.
That is the epicenter of the divide right now on the FOMC. That was the former Kansas City Fed President Esther George. Is the weakness, so-called weakness we're seeing in the labor market, cyclical or structural? Is it things like immigration, AI, or is it just the economy starting to roll over? And we can't settle that debate. Much harder to settle that debate without data. But to your point, Lisa, even when you have it, we're not settling that debate.
It kind of depends on the sector. It depends on the age cohort. It depends on the income level. It depends on the specific company. There's so many different crosswinds that it's so hard to get a handle on, let alone come up with some sort of cohesive policy.
Which is why we've got gridlock on the FOMC at the moment, coming into that December meeting on December 10th, about 6 weeks away. In the equity market at the moment, as we count you down to that opening bell, about 43 minutes away, equity futures positive by 0.2% on the S&P. On the NASDAQ, up by 0.2% also. Similar move on the Russell this morning. As we count you down to the opening bell, your trading diary looks like this for the rest of the week and into next. 10 a.m. Eastern Time, President Donald Trump making an announcement, so look out for that. Also today, a slew of Fed speak, plus Airbnb earnings after the close at 6 p.m. Eastern Time, a Tesla shareholder meeting. And on Friday, going into the weekend, UMich consumer sentiment. And that is all we've got going into the weekend.
So I know that you're going to trade on it. And actually, tomorrow you're going to come in and say...
I'm staying late at work,
yeah. You're going to say it's University of Michigan Friday.
UMich Friday.
UMich Friday. I think that's right there with the ADP Wednesday.
I'm right there with UMich Friday and ADP Wednesday.
Oh, is that the case?
Yeah,
Are you
big on UMich. Regular viewers of this program know that I'm super into ADP and UMich.
Yeah, you mean just talking about UMich.
And going
not
on cruises.
And
going on cruises.
Disney cruises.
Yeah.
Yeah, big time.
Carnival.
The bigger, the better.
Big cruise
icon.
fan.
Honestly,
Icon
of the Seas has Jonathan Ferro written
when I knew
over it.
When I knew that shit was launching, I was like, saving my money on the weekends, just getting ready to go on Icon of the Seas. I couldn't wait.
I have seen you on that water slide.
Yeah.
Just whee!
Just buzzing. You know me. Just love it.
All right.
Let's turn back to markets. Bond yields falling. Just never going to happen. On rate butts, after data showed US companies announced the most job cuts for any October in more than 2 decades. Nisha Patel of Parametric joins us now for more. Nisha, good morning. Not going to talk about cruises. I hate them.
I didn't take you for the cruise type, John. I'm just saying.
I'm not that kind of guy. You know me well enough. Let's talk about this bond market. The data, is it weak or is it okay? Is it stable? ISM services yesterday was great. Challenger job cuts today, terrible. Which one is it?
depends on what day you ask me, right? I mean, it's been very noisy. I think generally for the most part, it looks like it's holding up fairly well. But I think where this could turn is once the data comes back online, if you start having the actual data that the Fed is focused on showing weakness, I mean, then we've already crossed over that territory. It's perhaps that we just don't know yet. And that's primarily what the Fed is focused on, right? I think Chairman Powell has more or less reiterated 3% inflation is now the 2%, but it's transitory. And then at what point does a very weak labor market start becoming disinflationary, right? That is what they're most concerned about.
Can we see a reacceleration in the economy without jobs? I mean, this is really the fundamental question as we talk about Fed policy and the potential for a reacceleration in GDP, as we were just talking about with Neela Richardson, at the same time that we're not seeing job creation. Is that sort of the soft landing that people are talking about, or is this an anomaly that means the data is not right?
Yeah, I mean, look, the soft landing can happen where, look, right now, I think the guest before exactly mentioned, like, we're in this very slow hiring, no firing. And perhaps the AI productivity gains, right, that you're seeing at the company level is contributing to that. But if at some point you do start to see companies increasing that layoff, right, there becomes a thin line of, okay, we can not hire as much. We have great productivity, great net, wages stay the same, earnings stay strong. But if they do start increasing the pace of layoffs, you have a direct impact on consumer spending, right? Therefore, it's hard to see kind of how you keep this momentum going, meaning that you hit a dip, and then perhaps if there is maybe more of a sustained corporate level strength and earning, again, you back to no hiring, not as much as layoffs, maybe you start to see a little bit of that come back. And then more importantly, look, tariffs is still in the background here, right? Is this really transitory? So I think that's another element here that in terms of inflation, and the impact that has.
I thought you meant that tariffs might be transitory, because that also might be the case.
That also could be the case,
yes.
exactly.
So dovetail all of this muddle into the bond market. How do you get conviction to say, I want to lock in yields here, when you can have 5 people in a room and 25 different opinions on exactly what the macro is going to look like?
So what we've been telling our investors is a few things. I think real yields are attractive, right? If you take a look at real yields today, they are attractive. You don't have to go down significantly in credit quality today. And look, you don't have to take on a lot of duration, right? I think the story here is about the income component. So you're not betting on rates falling, the economy falling over. We don't want that to happen. But if we're in this sustained environment where 10-year yields are roughly in a 4% range, this is a good opportunity to add income at a time where reinvestment risk of sitting in cash is increasing, right? If the Fed continues to ease. And at a time where, maybe let's face it, the risk on trade has been very strong, very long. Investors could be slightly underbalanced right on the fixed income side, and you have a way to diversify portfolios without giving up meaningful return potential.
Let's talk about finances at the federal level, and then we'll get to the state level in just a moment. At the federal level, what happens to treasuries if the Supreme Court comes out and says, no, you can't do this anymore, and they can't raise money from tariffs in quite the same way, with the same tools?
Yeah. Look, I think in that case, you have tariffs were being banked on as a revenue source, right? So now you have, I think, the reemergence, I guess, of debts and deficit concerns. That's always been there in the background. But now you're like, wait a minute, we're supposed to get all this revenue at the federal level, right, supposedly from tariffs. And now all of a sudden we're seeing we can't see a lot of that. That reemerges the concerns, I think, at the federal level on the debt and deficit. So you could see a further steepener. You could see more of that term premium being built in. I think that's very likely to happen, right? I think that's kind of been brought down a little bit because that hasn't been on the forefront. At the state level, you have a few things happening here. Now, the good news is at the state level, most city levels, they have to balance their budget, right? You can't run it into deficits like you can at the federal level. So that's a great news. So meaning you can't debt finance either, deficit finance. So you have to make kind of your expenses and revenues work. Now, states are also facing similar impact. Government shutdown, I would say, is limited impact. That's very sector-based, very regional. But for entities that are running on a very limited reserve level, and you don't have federal funds coming in, that is going to be a direct fiscal impact. And then secondarily, Medicaid funding, right? $1 trillion over the next 10 years. That is reduced at the state level, which states will have to manage for. Good news is, I think states are in a good place you can argue in many ways in the federal government in terms of the balanced budgets that they have going forward.
Did you take phone calls about New York this week?
Oh, yes.
What do you say back to people who are worried?
Yes. So I think what you want to remember about most large cities and states, I mentioned they have to balance their budgets. So there's a lot of legal and fiscal discipline framework in cities like New York that's in place. So if you think about their budget, New York City has to release a 4-year budget going out in advance. If there's any major deviation, right, that kicks in a fiscal control board that was created back in the 70s. The debt issuance is also capped. So where it's like, we'll issue a lot of debt, we'll pay for it via debt, there's a cap of 10% based off of 5-year property value level. Very manageable. So my answer is there's a tremendous amount of strength. New York City has seen a lot. If you just look at it from an economic perspective, right, 9/11 and global financial crisis, COVID, they have been very resilient. The city's been very resilient, right? You've seen no change in their ratings and their kind of fiscal discipline. So, you will have policy regimes change, shifts come in place, but we're telling our clients not much to concern. And if spreads widen out, it's a good buying opportunity.
We'll put some of those politicians on the icon of the season.
Yeah,
Wishing the best. Nisha, thank you.
With you.
No, thank you. Nisha Patel of Parametric. Nisha, thank you.
Appreciate
it. Thank you. Coming up tomorrow, Jeffrey Yu of BNY, Brian Gardner of Stifel, Michelle Weaver and Nadia Lovell from New York City this morning. Good morning. You're watching Bloomberg TV.
Day 5 at the WTA Finals in Riyadh. Amanda Anisimova fought back from a set down against Iga Swiatek to book her place in the Final Four. The American fired 30 winners on her way to closing it out 6-2 in the decider. Earlier, Elena Rybakina kept her perfect record intact as she took out alternate Ekaterina Alexandrova in straight sets. The victory was Rybakina's 10th top 10 win in 2025.